Good morning and a very warm welcome to the second day of our annual research conference. My name is Peydró and I am from the ECB's research department. I will guide you through this session. The session is about central banks and regulation. We will have two papers, two discussants per paper, and a Q&A after each paper. With the first paper, we will return to an important topic of financial stability and monetary policy that we already discussed yesterday. The presenter is Professor Tobias Berg from Goethe University, Frankfurt. Welcome. And the discussants are Professor Amir Sufi from the University of Chicago Booth School of Business and Professor José-Luis Peydró from Lewis University and EIF. Welcome. Without further ado, it is my pleasure to give the floor to Tobias. He will talk about unintended consequences of QE, real estate prices and financial stability. Tobias, the floor is yours. You have 20 minutes.
So thank you, first of all, for including our paper on the program. It's joint work with Rainer Haselmann, Thomas Kick, and Sebastian Schreiber. One of the authors is at Bundesbank, so the typical disclaimer applies. Our paper is about one QE program, the Corporate Sector Purchase Program. And let me give you, it's early in the morning, so let me give you the key messages right away. So in the following 20 minutes, I'll try to convince you that this CSPP program increased real estate prices in Germany and impaired financial stability in Germany. For those of you who are not interested in QE, which is maybe unlikely at this event, or let's put it like this, who are interested beyond QE, there's also a message about real estate prices in general. We find elasticities of real estate prices to credit supply shocks, to positive credit supply shocks, that are significantly higher than prior estimates, okay? And I'll walk through the presentation and hopefully be able to explain to you why. So as I said, our paper is about the Corporate Sector Purchase Program. So the Corporate Sector Purchase Program, or in short CSPP, was enacted by the ECB in 2016. The ECB bought at the peak 350 billion corporate bonds, investment grade rated. So this is a sizable amount. So this was 31% of the outstanding amount of eligible bonds and equivalent to 7% of Eurozone bank lending. So really a big program relative kind of to corporate lending or the corporate bond market. There's similar programs in other countries, Japan, UK, and the US. And the key rationale here cited by the ECB was to overcome credit supply frictions that were present in some European countries. Let me give you an overview about these credit supply frictions. So what you see on this graph is the answer to the question to firms, asked to firms, do you have problems with access to finance? And the blue line here is Germany. And what you can see is that Germany at that time when the CSPP was enacted did not have a problem with access to finance. So this is what we label in the paper as a credit-saturated market. So in that sense, we are asking a kind of strange question. We are asking the question, what happens if you implement a program in a country where the frictions that it's supposed to address do not exist? So it's a little bit akin to asking, what happens if you send a firefighter to a house that's not burning? We still think this question is relevant because most monetary unions are actually quite heterogeneous. So certain conditions might apply to some areas but not to others. Plus, even if you have a homogeneous union, it could be that certain programs are maybe enacted too long when the underlying frictions are already resolved. So the prior literature on QE and in particular CSPP has established a very simple channel. The ECB or the Federal Reserve or any central bank, when they buy corporate bonds, then those large investment grade rated firms that can issue bonds shift from bank lending to issuing more corporate bonds. And this frees up lending capacity at these affected banks. And so these affected banks increase lending to smaller and medium-sized enterprises. So the message in prior papers was pretty positive that not only the large firms benefit, but also the smaller and medium-sized enterprises actually benefit from an increase in credit supply. We add to this literature actually in two ways. The first one is we look at a credit-saturated market. At Germany, where these credit supply frictions at that time did not exist to that extent. And number two, we look at actually where is this additional lending going? And as you can see probably from my initial remarks, the answer will be it fully goes into real estate lending with the consequences that I will document in the following. Our data is pretty standard data. So we use credit registry data from Germany from 2012 to 2019, so symmetric around this CSPP start in 2016. We enrich it with firm level data and bank level data. And for the county level analyses we use classical or standard home price indices from Bulwiengesa plus county level characteristics. Again, nothing special about this from standard databases. Empirically, what we do is a simple difference in difference. So we compare the lending of affected banks to those by unaffected banks pre and post CSPP. If I talk about affected banks, I'll obviously have to tell you what are affected banks. So affected banks, in our case, are those where the share of lending to these CSPP eligible firms is above the median. So if a simple 50-50 split, did this bank actually had a pretty high exposure to these investment grade rated large corporations in its lending portfolio or a smaller one? Okay? And this carries over to the county level where we aggregate the CSPP effectiveness based on the firms that sit in this particular county. So all in all, a quite standard, simple difference in difference. And the typical question you would always ask for a difference in difference is obviously, are treated and controlled banks comparable? And the first answer is, they're obviously not comparable on those things where we don't want them to be comparable, where by design they are different. So if you look here at the share of eligible firms, this is on average a little bit more than 13% for treated banks and close to 0 for control banks. So these are numbers which can be important to keep in mind. So those treated banks have roughly 13.5% of their loan portfolio, which has gone prior to CSPP to CSPP eligible firms. Now, obviously, these CSPP eligible firms are investment grade rated. So anything that has to do with the creditworthiness of the bank portfolio, the share of high yield exposure, the average PD is therefore also lower for treated banks than for control banks. But on all other characteristics, which are unrelated to this credit quality criterion, these banks are rather similar. No matter whether you look at profit and loss statements or bank balance sheet information, they are rather similar on all other respects. A small exception is the total assets, because all the big banks in Germany, they're actually exposed to the CSPP. So while median assets are slightly smaller for treated banks, average assets are somewhat bigger, while we can simply exclude the biggest 5 banks and you will see a very similar size distribution here. In Germany, most banks are locally active. This obviously also helps later on for identification of the county level results. So let me show you the key result in 4 or 5 pictures here. First of all, as expected and as already documented by prior paper, these are all difference, the standard difference in difference coefficients. The share of CSP eligible portfolios in these treated banks' lending portfolios goes down. Why? Because these firms find it more attractive to issue bonds, given that bond spreads decreased. So this is kind of more or less a trivial result. You wouldn't find it that there'd be an issue with this. Economically, this adds up to, or cumulatively up to 2.5% at the end of our sample period, relative to the pre-CSPP exposure of a little bit more than 13%. Overall lending remains flat. So we don't find a difference in the size of the overall lending portfolio of treated and control banks. This begs for the question, where does the additional lending go to? CSPP lending goes down, so it must go up somewhere. That's simple balance sheet arithmetics. And it turns out it all ends up in real estate lending. So the blue line here, this is the dynamic version of, or basically the last two slides ago that I've shown you. The share of eligibles in the treated banks portfolio goes down. The share of real estate lending in the treated portfolio goes up, and all other lending remains flat. Pre-CSPP for treated banks, real estate lending was responsible for roughly 40%, so it's sizable, and the other portfolio for roughly 50%, with the CSPP part responsible for the rest. Now, real estate is not a homogeneous lending exposure. And so it's also important to look at where does it actually go to within the real estate portfolio. Remember, this is all corporate lending, so we're not talking about retail mortgages here, but we're talking about corporate lending. Now, if you look at it, we look at three different subsectors of the real estate industry. Construction, so these are the firms that actually build houses. Development, so these are the developers. And real estate asset managers, so these are the firms, like in the US, you would maybe call them REITs or so, that actually borrow money, buy houses to lend them out. In Germany, I have to say these real estate asset managers are pretty small, so with average assets around 10 million, so they're almost all bank dependent. Now, crucially, the construction sector and the development sector don't see any increase in credit. It's all concentrated in real estate asset managers. Why is this important? It's important because construction and development actually increases the supply of houses. They build and develop houses. Versus the asset manager, they actually increase the demand for houses by providing cheap lending to these firms who buy houses. So therefore, whenever you're interested in real estate prices, elasticity of real estate prices to credit supply, it's really important to ask the question, does this extra real estate lending actually end up in those subsectors that build houses and develop houses, or those that are on the buying side that actually buy houses? And here it all ends up in the real estate asset management industry, so kind of in the buy side, so to say, of this real estate market. Now, you can look at this in more detail across all industries, because so far I've just lumped together all industries apart from real estate in one single bullet point or one single graph. And here you see it across 14 different industries. The coefficient for eligible is negative. The one for real estate asset managers is positive. And for all other industries, we basically find a zero effect. Now, let me go to real estate prices. For real estate prices, we go on the county level. Okay? So we look at those counties that are more exposed to CSPP versus those that are less exposed to CSPP. And you see an increase of roughly 5% of real estate prices in this difference in different setting and interpretation in the treated counties. You also find an increase in typical measures of real estate valuation, price-to-rent ratios, or price-to-income ratios. I have to say, if you look at the descriptive statistics here, the treated counties tend to be more the counties with a slightly higher GDP per capita, so a little bit more the richer counties with slightly higher valuations. So it's not a catching up of poor counties or something like this in the real estate prices. And due to some quirks in the institution setting in Germany, you also find a slight increase in rents actually in these counties. So the income in these counties does not change at all compared to the control counties. Now, we have lots of robustness tests, and I just want to highlight a couple of these. So whenever you want to find an alternative explanation, you need an explanation that is consistent kind of with the following robustness test. These effects start to kick in directly when the CSPP kicks in, so there are no pre-trends. Yeah? That's kind of number one that I want to highlight here. Number two that I want to highlight here, we don't find any effect for single-family houses. In Germany, single-family houses are almost never rented out. Okay? So you buy them when you live in them, but it's not a typical rental market. The proportion that is rented out is very, very small. So this is not a target for asset managers. These asset managers who want to buy real estate and rent them out, they buy apartments, apartment blocks, but not single-family houses. Okay? So this suggests that in the same counties, it's not the single-family houses or everything that's being lifted up, but just those areas or those properties where real estate asset managers actually invest. And the third one that I want to highlight here is we look at differences in treated and control counties, and we look at firms that are not in the real estate sector. Yeah? Think about manufacturing, services, and others. And we don't find any differential effect for growth or revenue or profitability. So we would argue that kind of these robustness tests put a rather high bar on any alternative explanation. There's one assumption that I'm clearly not going to defend, the stable unit treatment value assumption or the no spillover assumption. It's clear that surely there will exist some spillovers across county because even the regional German banks are sometimes active a little bit across counties. So if at all, you could see our estimate as more a lower bound of the real effects here. Now you could ask, why real estate asset managers? What's the mechanism behind this? So one is a supply side argument. They seem to be a good substitution for the investment grade lending that went to the bond market. Why? Because there's a very high collateralization, real estate is treated favorable in the Basel regulation, so they attract a rather low risk weight. The other one is a demand side argument. One guy from a bank once told me when they needed to lend more and they didn't have lending opportunity, his boss told him, go to the real estate firms, they always need money. And this claim of go to the real estate firms, they always need money, in our economic terms would be, they have the highest elasticity. If you kind of slightly decrease rates or conditions, they will borrow much more, versus a manufacturing firm will not be thrilled if you offer them a 10 basis points discount. They will not just open up a new production line. And let me highlight this actually by showing you here two sectors, real estate asset management and manufacturing. These are both small firms on average in Germany, so highly reliant on banks. But you see a big difference in their employment to total asset ratio, which means real estate asset managers stand out in that they are very capital intensive. You can manage a 10 million or 100 million real estate portfolio with very few people. You can't do that in manufacturing. So if you want to scale up in manufacturing or in the restaurant business, you also need to hire, but the labor market was pretty tight at that time in Germany. In real estate asset management, if capital becomes cheaper, you can easily actually scale up that business. Okay? And therefore, so I think this is one of the key arguments why we are saying this is actually where the money is flowing to. Okay, let me talk about, in my last one or two slides, about elasticities of real estate prices to credit supply and a little bit about financial stability. So we find an elasticity of real estate prices to credit supply of 0.8, which is 2 to 5 times higher than prior estimates in other papers that have used deregulation shocks or other shocks to credit supply. Why? We argue this is particularly the case because we are in this credit-saturated economy where basically construction firms, developers, they don't even find enough people to scale up. So if all the lending actually flows to real estate asset management, the buy side in the real estate sector, and not the ones who actually construct new houses, then you will see elasticities that are much higher than you get in, let's say, a typical credit supply expansion, which is more equally distributed across these sectors. So this matters because it means if you are in a hot economy, and if the additional lending supply is entirely going to these asset managers, you can see an increase in real estate prices much quicker than you might otherwise think from prior estimates in the literature. Why should we care? At the same time where this CSPP was increasing real estate prices in Germany, there were warnings by the European Systemic Risk Board about vulnerabilities in the real estate sector in Germany. So while kind of one part of the regulation was saying, oh, the buildup of real estate prices is maybe too fast or too big relative to fundamentals, other parts were driving this, the CSPP program in our case. And we're not necessarily taking a stance on whether this is a bubble or not, because this is very hard to judge with hard data in real time. But at least these warnings by the Systemic Risk Board and others suggest that policymakers were concerned about the buildup of real estate prices in Germany. And the targeted long-term refinancing operation by the ECB, that actually particularly excluded lending to real estate sector for particular that reason. Okay, I'll skip actually the European evidence. If you're more interested in evidence across other countries, feel free to ask during the discussion. So in the interest of time, I'll quickly talk about financial stability. When you look now at banks' changes to their average probability of default, but also loan loss provisions, they increase for treated firms. And that's not surprising, I think, because the low-risk firms or the low-risk exposures, they move to the bond market, And so the real estate exposure here is, in some sense, more risky than the exposure that went to the bond market. At the same time, banks become more reliant on real estate collateral. They already had a large reliance, and real estate asset manager again bring real estate collateral, and these portfolios become somewhat more concentrated. You also see higher write-offs for treated firms. You don't see any change in net interest income. So these banks are not able to charge higher interest rates. Yeah, they are short in lending, so they need to lend more, but at lower rates on average to riskier firms, so that equalizes net interest income again, so that their return on assets decreases by 6 to 7%. So this is the evidence why we point out it might have been negative for financial stability in Germany. So to wrap up again with the key messages, we argue the CSPP increased real estate prices in Germany because the additional lending entirely went to the real estate sector, to the demand side. It impaired financial stability, and beyond CSPP, when you have a credit boom that entirely goes to the demand side, to the asset managers, you see pretty high elasticities of prices to credit supply. Thank you.
The first discussant is Amir Sufi. Amir, the floor is yours.
All right, first, thank you very much to the European Central Bank and to Hoover for inviting me to discuss this really interesting paper. And in general, thank you for running such a fantastic conference. Everything has been really great. Let me give you my bottom line. This is a really great paper. I think it's great for a lot of reasons. First of all, we always want to know from a policy perspective what the ultimate effects were. And I think this is just a great postmortem on the corporate sector purchase program. Furthermore, I really like the paper because it's at the intersection of finance and the real economy. And I think we always need to be careful, as a financial economist myself, that we don't get too far removed from the real economy. So this paper has a really nice way of showing you not only the financial side, meaning how lending switched across different firms, but then also tracing it to the real side of the economy, because I think we would all agree that's ultimately what we care about: jobs, buildings, homes. And that's what this paper does, is really to trace through what the implications are for the real economy. So kudos to the author, and I think this is a great example of how research using the fantastic data at central banks should be done. I think Tobias did such a great job summarizing the paper. I'm going to do this really quick. So the focus is on bank lending in Germany. It's a diff and diff kind of standard argument where you're going to sort banks in Germany based on the fraction of the lending that was going to CSPP eligible borrowers, with the idea that, which was very prominently discussed by the ECB, that if the borrowers are eligible for the program, then those borrowers will then leave or not need the money from the bank, so that would free up lending at the bank to go to other firms, hopefully more small and medium enterprises, the kinds of firms that couldn't get credit easily. That was one of the primary justifications for the CSPP. So you sort the banks like that. You saw exactly, Tobias shows you these very nice results about where the lending goes. They go primarily to real estate for the treatment banks. Then you're going to kind of switch to a geographic level analysis where you're going to sort counties based on whether they're exposed to these treatment banks, and the treatment banks, the counties exposed to the treatment banks then have a much larger rise in real estate. So the kind of bottom line is in credit-saturated economies, efforts to boost bank lending to SMEs are unproductive and even adverse for financial stability. The first set of comments I want to give are kind of the standard, like almost referee, what we, I don't know if this phrase translates across. We say kicking the tires, in America when we're buying a car, just to make sure that, the car is kind of working. So let me give you kind of more discussant referee type comments, and then I want to move a little bit more big picture. I think the first thing is there's no doubt that this paper is novel, so I'm not questioning the novelty of the findings, but I think there is a lot of research on the CSPP, and I thought it would be helpful if the authors can do a little bit more in making sure that they distinguish exactly how their findings are related to the existing literature, especially this Gross-Roschkamp article, which has this flavor of, well, the money, a very similar design, and it doesn't talk about real estate at all, but it says, well, the money went to profitable small and medium enterprises. So I think maybe these real estate managers are quite profitable. Maybe that's how we reconcile, but I thought I would just like to know a little bit more about exactly how this paper is related to that paper, which has a little bit more of a positive spin on what the ultimate outcomes were from the program. If I were to isolate one main empirical concern is that, and I'm going to talk about this in more detail on the next slide, so let me just quickly say it, that you might worry that some of the treatment effect that they're finding is some sense of mean reversion, because once you sort banks on how much lending is going to eligible borrowers, you are in some sense sorting in the opposite of how much real estate lending they're doing. And so you worry that you're sorting on exactly the outcome variable. There might be a mechanical mean reversion, which I think the authors could easily resolve that concern with a few different strategies. The third main comment is just going to be, this is a bit of a cheap shot. I mean, the real estate findings are so stunning that they could probably make their own paper. And as a result, there's a lot of arguments that Tobias even said in his presentation, which I feel could be backed up with analysis. So why are these estimates on the elasticity of real estate prices with respect to credit supply so large? That's a question. I've thought about that elasticity a lot in my own research, and I think there are good arguments. For example, maybe housing supply is more inelastic in these areas. Maybe there is this credit saturated. There's a lot of arguments in the paper, but again, there could be more analysis to backing those arguments. And again, it's a bit of a cheap shot because that finding almost is another paper. It's so stunning how large those elasticities are. So, either lengthen the paper, maybe separate it off, or maybe write a follow-on paper. Here's the mean reversion point I wanted to show you. So let me just quickly say what I said before, right? So when you sort the banks by the fraction of lending going to eligible firms, you are in some sense sorting on 1 minus the amount of lending going to real estate non-eligible firms. So anytime you're sorting on the variable you're ultimately going to be looking at the outcome, you do worry about mechanical mean reversion. And there's a little bit of evidence that maybe some of that's there. If you just look in the pre-period, it does look like real estate lending is kind of going down a little bit for the treatment group. And so, there are ways you can easily kind of correct for this. There's so many robustness tests in the paper that I don't think this is going to matter ultimately, but I think in terms of a nitpicky referee comment, I think this is something I would push the authors on. And then let me step back and take a big picture sense of what I kind of think about the paper, given my own research, given the research of others. And that is, I think we need to appreciate more and more that in advanced economies, banks find it very useful in equilibrium to be lending to real estate firms. This is this fantastic paper by Dai Mueller and Emil Werner, who talked yesterday. I feel good. Emil didn't talk about any of his own research yesterday, so I get to talk about some of his research. And they have this fantastic point. They're sorting on real GDP per capita. So this is a paper about structural transformation, right? And it's showing you how much of value added is in real estate in richer countries, how much of employment, and then this really stunning finding, which is how much of credit is then allocated to real estate as countries get richer and richer, okay? Very important point, that when you're thinking about banks, and I think, again, even intermediation scholars aren't appreciating this as much as they need to. When you think about banks, you should be thinking about real estate. Like, banks primarily are focused on real estate, at least a plurality of what they're doing. In contrast, if you look at services, that's where the value-added employment kind of shift in really rich countries. Whereas banks and credit in general is pretty flat. Okay, so banks are always kind of suffering this issue in advanced economies, which is the most exciting, growing parts of the economy are the parts of the economy they don't focus in much. And I want to be very clear, when people say services, they sometimes think about what I would say kind of very boring, unproductive, like retail and restaurants. That's not at all what services are in advanced economy. Services are professional, scientific, technical services, business services. They're information services like Oracle and Google and Apple. So these are the industries that really skyrocket in importance in advanced economies. So why does that matter? Let me just go through a few numbers to show you. So if policy can only rely on banks, what should we expect? So the first thing I'm showing you here, now I'm an expert in the US, so I'm showing you a mix of US and German data here. This is the US. The change in value added by two-digit NAICS represents the change in value added from the 1970s to the last 10 years in the United States. And these are the top 5 industries that have shifted. So everyone always knows manufacturing's gone down. I always find that a little unsatisfying. Well, what's going up, right? Shares have to add up to 100. So you can see business services is number 1, then healthcare, then real estate, then administrative and support, and then information, right? 5 arguably of the most important industries now in advanced economies. So these are the industries that have been growing over time a lot. The authors were nice enough to share with me the portfolio shares of lending by German banks across all the NAICS. And you can see that German banks are doing very, very little business in 4 of the 5 fastest growing industries in advanced economies. 30% is in real estate. And if you add up the rest, maybe you get some share. But again, these are portfolio shares. So you can see that very little of the lending is going to the firms in the industries that are growing fastest. Now, this is based on my own research. We exclude real estate, so I want to make comparison fair. So in the next column, I've just excluded real estate. So that's just a easy transformation. And now I'm showing you from some of the research I've been working on. It's not publicly available yet, but hopefully will be in the next. The portfolio shares of private equity, venture capital, and direct lending, private credit. And what you see right away is, maybe not surprisingly, that the portfolio shares of these other intermediaries are much larger in these fastest growing parts of the economy. And so the bottom line for me is, if you have a bank-centric economy and you only have policy levers over banks, it seems likely that the money is going to flow into real estate. So, I think, is this phrase credit saturated really fair for Germany? Well, maybe we mean bank credit saturated. But venture capital and private equity are intermediaries. They're not intermediaries that do debt financing, but they are intermediaries. And so I think there's like an agenda in the background, like monetary policy or central banking in an intangible economy. Like, how can central banks actually affect these other industries? And I think that's going to be a big question as we think about the implications of these findings. So overall, this is a great paper, a must read, and hopefully the foundation for more research. At a high level, my main takeaway is banks are not well positioned to finance the new economy. The policies designed to boost bank lending will likely affect real estate, consistent with the study's results. And we need more research on how central banking interacts with the intangible economy. Thank you very much.
José-Luis Peydró from Lewis University and EIF. Jose, all yours.
Yeah. So thanks a lot for inviting me to discuss this very nice paper, and also to be here in this conference. I learned a lot yesterday and this morning. So basically, very briefly in one-page summary, basically the question is, what are the effects of expansive monetary policy and one particular monetary policy, which is QE on buying corporate debt, in a country in which is not supposed to be having expansive monetary policy because there are no credit crunch type of problems as in the south of Europe. The data is, say, Germany, because Germany is not suffering these credit supply problems, with administrative data and with the introduction on this particular policy, the CSPP. The results are that the money goes not to the real sector in a sense, not to the real economy, and in particular go to the real sector, and within the real sector doesn't go to constructors and developers, but to real estate managers. And there is an associated, and this implies financial stability, some loan defaults, and there is an elasticity between real estate prices and credit supply, which tends to be high in the literature, around 0.84. So this is truly a very important paper. First of all, it's extremely polished. So it's a very polished paper. The question is super important, both for academia and for policy. The identification is excellent, and the results are very interesting. I'm going to pick up on some comments related to policy. So the authors conclude that there are adverse effects from these policies, in particular financial stability. So my discussion is going to touch on, is complementary to Amir, and is going to touch on public policy. Before I tell you about the public policy, let me just do only one slide on type of referee type of discussion. So the elasticity is very high, 0.84. And the authors put this hypothesis of saturated credit markets. In a sense, you don't need more liquidity and more credit in Germany because Germany is doing great. So going back to the presentation of Raghu yesterday, is kind of the arrest start, maybe you're using this policy in Portugal and Spain and Italy because given the economic fundamentals, interest rates are high, and therefore you need expansive monetary policy, but that is not the case, say, in Germany. Okay, and see, this is the hypothesis. And just very referee type of comment, and the only one that I have here, the others are more big picture, is that at the same time that the ECB introduced this policy, they introduced two massive policies, which is the normal quantitative easing, which is you buy government debts, and also they bought massively government debts from Germany, and you have this NIRP, negative interest rate policy, which started in mid-2014, but then in 2016 they lower again, and it's the first time that truly negative rates were in the economy. Okay, so you have these two policies, and the elasticity is very high. So a key point is to say, and this is a diff in diff, so is a correlation between the banks and the areas that are more benefited from the CSPP are also more benefited by NIRP and QE, or no? If they are not, which should be in the balance table, so I would advise you to put those things in the balance table, that's fine. If they are correlated, then you should fully control for those ones, because part of the 0.84 might be picking up all these alternative policies. This is purely monetary policy, but at the same time in Germany there was more than 1 million refugees, which implies things on real estate, on economy. Are all these guys, again, uncorrelated with your cross-sectional variation or no? This is my only comment on kind of referee. The rest are a kind of more policy. Before I enter into the policy, and I have only 5 minutes, let me just say very briefly, I'm going to say very briefly, so this expansive monetary policy is a contractual shock to banks, because banks receive less credit demand from the big companies. Now, in a Modigliani-Miller type of world, Modigliani-Miller type of world, like in a sense, there is like the saturated credit market. You don't need to invest this money because all the firms are fine. Okay? Let's then, if they are fine, and this is the hypothesis, then either the banks are taking too much risk. Why? Because you have expansive monetary policy, but it's contractive to the banks. The charter value of the banks goes down, and then they take more risk. So basically, the private NPV of the loan is negative. But it could be that it's positive. This is one hypothesis. It could be that it's positive, the private NPV, but what is negative is the social NPV. Why? Because there are these externalities on financial stability that you don't internalize. So it will be very important to understand these frictions. But I want to understand these frictions is for policy, because as I was saying, my comments are on policy. So the first line of defense is the prudential policy. And the prudential policy, again, is very important, the friction. Is the friction credit supply as you put forward, or is the friction more credit demand? Because then you can do macroprudential policy, and this is very important in the euro area, which the macroprudential policy, part of the macroprudential policy is at the state level, it's not at the ECB level. But then, of course, you need to say, should I use macropru, and then on borrowers, credit demand, or on lenders, credit supply. You could also use countercyclical capital buffer. Let me advertise some of my papers. Raghu was very nice advertising some of my papers yesterday. But I have this old paper with Angela Maddaloni that we find that softer monetary policy, soften lending standards, but this is reduced with tightening of prudential policy. So the question could be, you could read this, maybe the ECB did too much, or you could say maybe the German authorities, the German Bundesbank, the government, they should have introduced countercyclical capital buffers. They did not. Okay, so you have this monetary policy, which might be potentially not optimal, but you have other policy tools to combat this. Now, these buffers, truly speaking, if they would have had those buffers, they are tiny. They are truly tiny. And there was a comment yesterday, an answer by Ragu on countercyclical capitals in Spain, which I studied. We have a paper in the Journal of Political Economy on that. So those buffers were working amazingly well. But they were 1% of total assets. They were 25% of equity, so they are huge. The bankers in Spain complain because they are 25% of equity, but they are 1% of total assets. And our crisis was not 1% of total assets, was much larger. So in a sense, one of the big problems of prudential policy is that the buffers might be too small depending on the imbalances. So if the imbalances are high, maybe it's not enough, maybe it's good prudential policy, but maybe it's not enough. So going back to the presentation of Raul yesterday, maybe monetary policy is interesting. I presented this paper here 2 weeks before at the Silicon Valley Bank, this paper on monetary policy EU. I just wanted to make one point on the link between monetary policy rates and instability. So it's just not purely low rates. You can have low rates, but these low rates should be lower than a particular threshold, systematic component of monetary policy, R star, whatever. So it should be low for long, but they should generate somehow a credit boom and asset price boom. Real estate is bad in the history. Okay, so you should have that. Then what you find in the history of financial crisis is that credit supply, which is consistent with your results, credit supply determinants of these booms, one part has to be coming from the credit supply. And then you have a strong tightening of monetary policy. But even if you have all these conditions, and there are many conditions, you can up to increase the probability of default, probability of a crisis up to 40%, which is high, but still, Germany didn't have a banking crisis. Regulation, many people in Europe think that regulation was good compared to the United States. We have the LCR, net stable funding ratio, some countercyclical capital buffers. But still, nevertheless, the probability of a crisis is high, but it's not so high. Still, the probability for not a crisis is even higher. So maybe this is outside this type of conference. Maybe the social costs, which are very important on financial stability, are other type of cost. So you are showing very clearly that there is an increase in real estate prices. You have a wonderful identification, which is some areas and some banks are more affected by this. They lend to these real estate agencies. They increase real estate prices massively. So I would love you to see whether this led to some political polarization, some political extremism. I think this social cost could be important, maybe zero. That would be wonderful for this audience. That would be wonderful, no? But maybe there is some potential effects. And you have the perfect setting, identification setting, to do this. My last slide is just to say that, let me tell you another thing from Spain. You might not know that. In Spain, so first of all, in Spain, we also had, similar to you, we had interest rates which were very low at that time. In 2003, 2002, Ireland and Spain had extremely low interest rates. Because the sick man of Europe at that time, I think the economy said, was Germany. So the interest rates were very low. And this created a massive expansion of credit. But at the same time, there was a relaxation on real estate construction. So you would have asset prices going up and construction going up. Here, everything in the German case is just real estate prices, because the loans don't go to the construction and developers. Now, another thing, maybe another paper that you could write is, since Germany is a federal state, since the regulation is different across landers and across cities, you could exploit whether in landers and in cities in which it's easier to build, then the expansion of credit was also going to construction companies and developers, then you find not only higher real estate prices, but higher construction real estate. And then people are not pissed off because the real estate prices are lower, and then they have more houses, especially also thinking that Germany got more than 1 million people. As I said, this is a wonderful paper, and my comments are on policy, and I only have one tiny comment on identification. Thanks a lot.
Tobias, if you want, you can take a couple of minutes to respond to the discussants' comments, and then we open to the floor.
Okay, thank you for that one. I'll try to keep it short in order to have time for the general discussion. So thanks a lot to both of you for these discussions. Sometimes you go into these conferences and think you have a very good paper, and after the discussions you go out and you think I have a paper. Yeah. Here I actually go out and think I have 5 more ideas for potentially great papers, which is fantastic. Yeah. So like all these ideas very much with ex-post polarization, the slide on value added kept me thinking all the time. So I think there's a lot of food for thought also for additional papers within our setting, or maybe also called to the audience. Just very quickly on 2 of the 3 of the things you mentioned. Identification, very well taken. We do something on QE. Refugees, we didn't really think about this so far. Our treated counties are more the slightly richer ones, where I think actually refugees were more placed in the slightly poorer counties in Germany, but we'll need to look into this. We'll just have to do this. Counter-cyclical capital buffers. I think that's a very interesting point, because I know there was a call for this. I also know that the German regulatory bodies, maybe Claudia Buch can even say more later on, tried to do that. It was also enacted slightly before COVID. So I think it's a typical situation where you get a lot of kind of lobbying against this. I was myself on a panel in these years where someone from the real estate industry said, we don't need this buffer. Germany is different. Yeah, and they didn't even know this book this time is different. So I couldn't even make that joke, so to say. Yeah. And so you get this political backlash, and the result is typically, as Raghu also yesterday said, that these things tend to be kind of too small relative to these other forces at play. Last short point, the relation to Große Rischkamp, their paper. So these other papers are mostly in either other countries or in the European setting. And to be very clear, I didn't have enough time in the presentation because the clock was chasing me. There is some evidence which we are currently building that actually only in countries in Europe that were credit saturated did you see a significant increase in real estate lending, but in other countries it worked in a different way. So we're not saying it was bad for Europe, just if you zoom in on these credit saturated countries, this is what you get. And the other thing is, I think if you do regressions on the firm level, on profitability or employment, then real estate firms in the middle of a real estate boom are very peculiar types of firms. Yes, they are probably highly profitable. We should look into this. And if these real estate asset managers increase their staff from 2 to 3 people, that's a 50% increase if you do a regression in logs. Yeah? And I think there you have to be very careful when it comes to the real estate. Just looking at employment and profitability can be misleading, because employment is such a low base and profitability is highly itself dependent on kind of the real estate market situation. Thanks. I think I'll leave it for this for now and can take questions from the floor.
We have time for questions. I see already many hands up. Please stand up when you ask the question. State your name and affiliation. Thank you. You have microphones?
Thank you. My name is Leo van Taden from the ECB, from the Directorate Monetary Policy. I think this is a super interesting paper. I like it, but let me still reinforce one thing that was mentioned by the 2 discussants. I think there was something deeper going on in the background, monetary policy. I mean, the primary motivation of QE comes from the price stability objective of the ECB in a situation where many people felt that we were near to the effective lower bound. From this perspective, I think Germany was not a particular outlier. So if that is correct, I'm not sure, you can discuss it. I know that, I mean, you can think differently about QE. The true question you address in your great paper is how to structure flexibility across the available range of non-standard measures that you have in a multi-country monetary union with a lot of heterogeneity. you could argue from the perspective of your paper not to include Germany in this particular sub-program in terms of volume, very small to what we bought. The majority fell on sovereign paper, right? But if you do this, you have to do it program by program. And there needs also to be a certain balance. Assume in the sphere of sovereign papers, we had to decide not to have something like the capital key. Then you would have to think about side effects of such decision. So I like your paper a lot, but the monetary policy main motivation would help to structure things.
Yeah, thanks a lot for the comment. So I don't envy central bankers who need to do monetary policy and these type of programs in highly heterogeneous currency unions. And to be very clear, we are not saying that this was welfare decreasing the program. We're just saying there are some effects in countries where these credit supply frictions existed, where they might have been alleviated. But there are also unintended consequences in those countries where these credit supply frictions didn't exist. So looked at a lot of speeches, so credit supply frictions as a rationale for this program feature quite prominently. But to be very clear in that sense, I don't envy these policymakers who had to make these decisions, because in the end, you're facing really a heterogeneous situations, and it's very hard in practice to implement a heterogeneous monetary policy across one monetary union. Yeah, it's just difficult for political reasons, but also practical reasons.
Raghu wanted to ask a question.
Yeah, Raghu Rajan, Chicago booth. Great paper. I think you can draw parallels to at least one big experiment in Japan in the late 1980s when they liberalized the bond markets. And a lot of the good companies went to the bond markets. The banks didn't know who to lend to. And that started the mother of all real estate bubbles in Japan. Seems very, very parallel to what you're showing here. But I think that raises two questions. One is the issue of financial development. You have a policy experiment. You could equally pose it as a financial development issue, right? That new sources of finance emerge, banks are then flailing around, and then they go into the stuff they know, real estate, as Amir puts it. That seems to be their go-to thing, and they just lend like crazy there. So that could have implications for what's happening in the US even today, right? With private credit expanding, all that we heard yesterday, that banks are now trying to look for new sources of lending, and what do they find? So that's one point. The second is it also raises this question, why don't banks sit on their cash? Why does the cash coming in have to be lent out? And it seems like first they draw it in, and then in a sense, they don't reduce their deposit rates and shrink their balance sheet. They want to continue lending. That to me is a huge agency problem, which we need to examine in greater detail. We call it sort of money burning a hole in your pocket, but I think it's possible in your data to look more closely at who's doing most of this and why. That would be interesting.
Thanks for this comment, and highly appreciated. I think you highlight kind of 3 points or links to other areas. The one is the Japanese experience, and I just 100% agree. There's actually a really fascinating parallel paper that looks at this Japanese experience with exactly the message that you also have in your mind, and empirical identification and the like. So bond market liberalization might have a very similar effect to what we actually see here. The other point is, and I hope I could actually allude to what you were saying yesterday. You were saying yesterday that whenever banks see lots of deposit inflows, they want to do something with this. And what they do is probably not as good as that we were doing before, because they struggle to find equally profitable investment opportunities for the next project. And so I think this is a parallel. No matter whether you see a deposit inflow or a decrease in lending demand from some subpart of your portfolio, for some reason, I think that's not very well understood. Banks just don't shrink simply, maybe for operational reasons, maybe for other reasons, but they look for opportunities, investment opportunities, which are not necessarily good. And the last link, I think, that you highlight maybe indirectly is to the session yesterday on non-banks. Some people were quite skeptical about banks actually lending to business development companies that then go out somewhere else. But if you have the direct lenders, like in Amir's slides, that are actually specialized maybe in lending to the service economy or the like, maybe this is an arrangement which is better from the welfare perspective, and then you can ask the question, why doesn't it happen in this context? And I'm beyond having an answer to this one at this stage.
There was a question on this side of the room, Oreste?
Oreste Tristani, ECB. Very, very interesting paper, and I was also struck by this high elasticity of the house prices to this increase in demand by a sector that, as you said, is very small. And I was wondering, so real estate prices have been soaring in Germany, especially in large cities, from ever since 2011-12. And I was wondering whether there is some correlation between these large cities and the richer counties that you mentioned, and whether this may also be affecting your high elasticity.
Yeah, so if you sort the counties, let's say, into those that you have in your mind, like city center of Munich, the big ones where real estate prices are very high, then the very urban areas, the very rural areas, and kind of then the middle urban areas, let's say, we find the biggest effects in these middle urban areas. So it's not in the city center of Munich or Frankfurt, but kind of in the outer areas there, for example. This is where we find the biggest effects. And so it doesn't seem to be just an effect of a larger development within these areas. If we, for example, sort counties by real estate prices prior to the CSPP into, I don't know, 5 quintiles or so, we see a differential effect in each of these quintiles depending on whether it's CSPP affected or not the counties. So what you're saying is absolutely true. There was a rise in certain cities, but it seems to be orthogonal to what we are measuring here. About the size of the elasticity, so whether it's small or large is sometimes a subjective feeling. I've also heard comments already, why is it so small? It's only 5 or 5 to 10%, depending on when you look at. So keep in mind that the entire credit supply is going to the demand side, real estate asset managers, and not the supply side, construction or developers. And these real estate asset managers, they're only focused on these apartment buildings, but not single-family houses or the like. And obviously, if a lot of lending only goes to the demand side and only in one segment, apartments, you probably get bigger effects than if it be more equally spread out across different sectors. Yeah, I think this is my best explanation. Otherwise, you could debate for a long time about is this too low or too high relative to the expectations you actually have.
Christian?
Thanks. Christian Kubica, ECB Research. A great paper, Tobias. I think it's very, very important for the design of monetary policy, and I think the key question for design of monetary policy is why does the money from banks go to real estate and not to the manufacturing sector? So where does this difference come from, right? And I think there can be 2 explanations, and you and also Amir hinted at them. One is that banks simply prefer real estate. Could be because of the great collateralization of loans in the real estate sector. The other one, and you also hinted at that one a little bit, is the low elasticity in other sectors, right? So credit is very saturated already at this time in others. In manufacturing, it's easy to get credit. Credit conditions are great, and there's a very low elasticity compared to the real estate sector, right? And so I'm just wondering where are we closer to? Which extreme? Is it more that banks have a preference for real estate? Because if banks have a preference for real estate, then should we even have monetary policy directed at banks, or do we need much more directed monetary policy at small and medium enterprises if we want to affect small and medium enterprises? At the same time, and that's kind of a second question, is could there even be positive effects that are desired by monetary policy through higher real estate prices, boosting demand by private households, because now their houses are worth more, right? You talked about those spillover effects, and that might actually be good in boosting inflation.
Do you mind if I say something really quick?
Sure.
I just wanted to say that we've been trying to very carefully sort industries by the intangible capital to total capital ratio. And one of the things that jumps out at the data is high-tech manufacturing, medical equipment manufacturing, computer and peripheral equipment manufacturing is actually a very intangible capital industry. There's a lot of R&D, a lot of sales and marketing, a lot of working with customers, and so those are not natural places where bank credit usually goes. Those tend to be very VC finance, very private equity finance. So I just wanted to point that out, that even in manufacturing, especially in advanced economies, these are not usually industries that banks typically focus on a lot. Sorry, go ahead.
Yeah, just very quickly, in the interest of time, so you're looking at this question, why? Why does it go there? And first of all, this is a big chunk of the pre-existing portfolio. So real estate asset managers make up 20% of this lending portfolio roughly. So as Amir already said, banks go where you know they already have expertise. You could ask, why don't they go into other 20% that they also already have? And I mean, our explanation is this combination. We cannot fully point it down to one of these, but the combination of it's in the interest of bank because of low risk weights and their expertise. But these are also the ones with the highest demand elasticity. So if you ease credit conditions, manufacturing firms will not double their loan demand, but if you slightly ease credit conditions, real estate asset managers are much more willing to take up more lending for the reasons I've explained, scalability, capital intensity, and the like. The second and last one, you said, is it maybe not unintended, but intended, because an increase in real estate prices can have positive side effects? I'll leave it with a statement of policymakers at that time. Policymakers at that time were not cheering the real estate price increases in Germany, but if you look at publications by the ECB, by the European Systemic Risk Board, they're always very cautious in saying this is a warning, maybe countercyclical capital buffers should be enacted. So if we take these policymakers at face value that are specialists in analyzing whether this is more a threat or an opportunity, then it seems more an unintended than an intended consequence.
Let us thank the speakers for this fantastic first paper, and we will be back shortly with the second paper. I am very pleased to welcome our next group of speakers. The second paper in this session will cover another very important topic, banking supervision. I'm joined on stage by Professor Kelly Xu from Yale University, who will present the paper. And our discussants are Professor Rafael Repullo from SEMFI and Claudia Buch, Chair of the Supervisory Board of the ECB. Kelly, the floor is yours.
Well, thank you very much to the organizers for the opportunity to present and participate in this wonderful conference. Today I'll be presenting joint research with Sumit Agarwal, Bernardo Moret, and Amit Seru. The usual disclaimers from the US Fed applies. So our research is about weighted noise, and we'll be studying discretion in regulation. So our paper is motivated by this fact that reliance on human discretion is absolutely pervasive in institutional design. Judges, scientific reviewers, patent examiners, HR committees are all allowed to use substantial amounts of personal discretion when they make decisions. Now, human discretion has the benefit of allowing for the use of soft information. So that's real but difficult to quantify information that is open to interpretation. However, the downside of human discretion is that it can lead to quite noisy judgments. So noise we define as a disagreement across decision makers if they were to consider the same information. That means then that the same case with the same hard and soft information, if assigned to a different decision maker, could receive an entirely different outcome. So we're going to show that this noise leads to real distortions and increases the amount of uncertainty and volatility in the system. So specifically in this paper, we study bank examiners who are assessing the safety and soundness of banks, and we ask why these trained professionals disagree with each other so much. We model their final decision as a weighted sum of component-level assessments across different issues, and we show that there are three main causes of this disagreement or noise. First, these examiners apply discretion to all components, even the relatively objective ones, such as their assessment of capital adequacy. Okay? Second, they attach extremely high weight to the most subjective issue. So specifically, we find that these bank examiners are assigning a 50% weight for their overall decision on just subjective assessments of the quality of management at these banks. And then finally, we show that there's a lot of heterogeneity across these examiners in how much they weight each particular component. That means then that even if they agree on every single issue, if they differ in their weights, they're going to differ in their overall decision. Okay? We then also explore the real effects of noise and also some of the benefits of allowing for this use of soft information. First, what we show is because there's so much heterogeneity across these examiners, we find that the majority of the time when banks receive a different rating than in their previous exam, that is due to differences in the assignment to a new examiner rather than differences in their true fundamental quality. Okay? Next, we show that this noise impacts real bank behavior. So when we look at exogenous changes in bank ratings due purely to a change in examiner assignment, that increase in ratings leads to substantial changes in bank capitalization and a reduction in loan growth. Okay? We also find evidence of anticipatory bank responses. So basically, because there's so much uncertainty and volatility that banks anticipate because they don't know which examiner they're going to be matched with, they adopt conservative actions in anticipation. Okay? We also show that discretion is not all bad. Okay? So these examiner decisions are not all noise. Discretion can be beneficial for making predictions through the usage of soft information. However, we show through various calibrations and simulations that placing moderate limits on the amount of discretion these bank examiners can exercise can translate both into more informative predictions of future bank outcomes while simultaneously reducing the amount of noise in the system. In terms of broader implications, I want to highlight this quote in an excellent book by Kahneman, Sabani, and Sunstein. What they argue is that if two felons, who both should be sentenced to 5 years in prison, receive sentences of 3 years and 7 years, justice has not on average been done. In noisy systems, errors do not cancel out, they add up. Okay? So what that means then, more broadly, is that even though we focus so much on random assignment really only guarantees fairness. Okay? We don't necessarily want a world in which we have lots of random variation and lots of these great exogenous instruments that empiricists love to use, because what that implies then is that outcomes are randomly assigned to cases instead of well matched to kind of the merits of each particular case. Let me get to our setting and framework. We're looking at prudential supervision of US banks. This ends in the assignment of a composite CAMELS rating 1 through 5, where 5 is a failing rating. Okay? CAMELS is an acronym. It stands for capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risk. The composite CAMELS rating has very important consequences for these banks. It affects their ability to do M&A, branching, access to the discount window, as well as government funding programs such as TARP. Okay. If these banks receive an unsatisfactory CAMELS rating, so that's 3 or higher, they typically react by dramatically increasing capitalization and reducing their lending. Okay. Now, in this setting, the examiners are given a lot of discretion in how to form this composite rating. So here's a quote from the St. Louis Fed. It says, "The composite rating is not an arithmetic average of the individual component ratings. Rather, some components are weighed more heavily than others based on examiner judgment of risk." So it's really up to the individual examiner how to weight these various issues. Now, our sample covers banks that are subject to regular examiner rotation. These banks are examined by state and federal agencies in alternating years and rotated across lead examiners within an agency region. So this allows us to make a random assignment assumption, which is that true bank quality, so both its hard information and the soft information that we don't observe, is uncorrelated with examiner identity within a region and time period. Empirically, we can support this assumption by showing that at least for unobservable metrics of bank quality, those are uncorrelated with examiner assignment. Okay? Now, examiner discretion can impact the outcomes of both small and very large banks. Unfortunately, we do have to exclude the very large banks from our sample because they're not subject to examiner discretion, but certainly discretion could matter for them as well. Our sample does include some very large regional banks, for example, Silicon Valley Bank and other banks that failed in the recent 2023 banking crisis. Okay. So here's our framework. Let's suppose each case has some optimal outcome Z star that we may not observe. Okay? Let Z be the actual decision, and we're going to say that's equal to Z star plus B plus E. Okay? So here, B is a population level bias. Perhaps on average, bank examiners are too tough relative to the preference of the social planner. Okay? E is going to be that additional error by individual decision makers. Okay? And the variance of E, which we're going to call sigma squared, that's the noise. Okay? So that's the extent to which examiners disagree with one another if they were to consider the same case. Okay? We're going to represent bank fundamentals by observable hard information, so that's X, as well as soft information, which is S. So soft information is not observable by us as econometricians. It's only accessible in this model through human discretion. Okay. So we're going to define discretion as the actual decision by these bank examiners minus the predicted decision conditional on hard information. So this means that discretion is equal to soft information plus the error component that contributes to individual noise. So this neatly decomposes discretion into 2 parts, good and bad. Okay, so the pro is that discretion allows for the use of soft information. The con is that discretion is going to now add individual noise. Okay? And now kind of the main trick of our empirical exercise is we rely on random assignment. That means then that decision makers see the same soft information in expectation. Okay? What that means then, to the extent there's a predictable component in how much discretion one person is exercising than another, if they see the same soft information, that means we can isolate their individual error. Okay. All right, one last page of framework, and I'll get to the results. We're going to model decision making as a weighted sum of decisions over component issue CL, where the decision makers can choose both the decisions over the issues as well as the weights. Okay? This allows us to do a fairly standard variance decomposition, and we show that disagreement can arise from 3 sources. Okay? So the first is, if these decision makers treat component issues as subjective, even the relatively objective ones, we're going to have higher disagreement. okay? Second, if they attach greater weight to the more subjective issues, then we're also going to have more disagreement, okay? And then finally, they could disagree in the weights themselves, okay? So this gives rise to the issue that even if we come to complete consensus over every single issue, if we disagree with one another on the weights, we're going to disagree on the final decision. And that disagreement further increases if we have greater disagreement in weights on the more subjective issues. Okay, so here's how we measure discretion. It's just the residual composite rating after conditioning on observable bank hard information. We have two measures of examiner level discretion. The first is examiner directional discretion. That's the average of the extent to which you differed from the predicted rating on all of your exams. This is a measure of the extent to which examiners are consistently more tough or lenient than other examiners within our sample. And again, random assignment implies that this is basically like an examiner fixed effect that can isolate the noise component. Okay. In some exercises, we also use the second measure of discretion, which we call absolute discretion. This is the average of the absolute value of my discretion across all the different exams that I've conducted, okay? This is a measure of how much examiners deviate from the predicted rating in either direction. This is also an important discretion measure to consider because on average, I could have zero directional discretion in that I'm not more tough or lenient on average than other examiners, but I heavily weight case-specific soft information or my own gut feelings, which means I'm generally very unpredictable. Here's our distributions of what we find in terms of the heterogeneity and discretion across examiners. To put the magnitudes as an economic interpretation, what we do is we imply empirical Bayes shrinkage to our estimates of examiner fixed effects. This is because, of course, in finite samples, these fixed effects could differ from one another just due to finite sample noise. Okay? After we do that, we find that the standard deviation of examiner discretion across these examiners is 0.13. Okay? And that really is quite large. So earlier research by Amir and others have shown that state agency examiners are more lenient than federal examiners. How much more lenient are they? By about 0.08. What we're finding is that the within agency variance in how lenient and tough examiners are, that variation actually exceeds the cross-agency difference. Okay? Another way to think about how much discretion there is in the sample is we look at the probability that a bank is going to get a higher or lower rating purely due to a change in examiner assignment rather than a change in its own quality. Okay? And what we find, I'll just summarize kind of the main takeaway here, the majority of cases in which banks receive a different rating than in the previous year, that's going to be due to a change in examiner assignment rather than change in the true quality of the bank and its either hard or soft information. Okay. Next, we look at why we disagree, which has to do with weights. So for a small sample of examiners, we actually see simultaneous ratings for the same bank at the same point in time, so we can directly measure disagreement. Okay? And we find here the first source of disagreement is they disagree on the composite issues themselves. Okay? So what we plot here is the fraction of observations for which two examiners give different composite or component ratings. Okay, so all of these issues are treated as subjective, but the most disagreement occurs for the management rating, and the second most subjective rating is assets. Okay. The second reason why we have so much disagreement is that these examiners are placing very, very high weight on the most subjective rating, which is an assessment of management quality. Okay? So when we try to estimate their weights, we're estimating nearly 50% of the weight across these 6 ratings is placed just on management quality. Okay? So this high weight on management is consistent with the research in psychology showing that people place a lot of weight, perhaps too much weight, on face-to-face interactions. Okay? It's also consistent with the research on halo effects and affective spillovers, which shows that when people have kind of a general impression that something is off, okay, they tend to put that into the most subjective component of the assessment. Okay. Finally, we find a lot of heterogeneity in weights across individual examiners. Okay? So this standard deviation here is just for the management rating, how much we disagree with one another and how much weight we put on management. Okay? So because of this disagreement in weights, okay, one, we're going to disagree with each other even if we agree on all of these component ratings. Okay? But further, we find the most disagreement for the most subjective issue on which there's already a lot of disagreement. So that's going to compound and add to disagreement. We also trace out some of the real effects of all of this noise. Here we use a jackknife IV strategy. So basically, we're going to use the fact that if an examiner tended to be tough on her other exams, she'll tend to give a tougher than predicted rating on this exam. And we're going to trace out the causal impact of this exogenously higher rating. Okay? And this is all due to noise rather than soft information here. Okay? So what we find is that exogenously higher ratings, so this is saying the bank is less healthy, that is associated with the bank taking pretty strong conservative actions in response, okay? We see that the bank gets a lower CAMELS rating, so that's a safer rating in the next exam. The bank increases its capitalization and experiences a full standard deviation decline in loan growth. We also find evidence of an anticipatory response, okay? So banks in states in which the examiners exercise more discretion, so they're exposed to more uncertainty about what their future rating is going to be, they ex ante adopt conservative actions by increasing their capitalization and reducing their loan growth. Okay? So this is similar to some of the macroeconomic uncertainty findings by Bloom and co-authors, in which firms reduce their investment in hiring due to macroeconomic uncertainty. Now, as policymakers, you might see this and say, that's great, we want banks to take more conservative actions. Okay? But this is a different form of, let's say, uncertainty or opacity compared to opacity in stress tests. There, with stress tests and other tests by the regulator, banks don't know what the formula is, but the regulator can fully control the amount of uncertainty in the environment. Here, the regulator also does not have full control of what these supervisors are going to do. So it's uncertainty on both sides. Okay. And then finally, we look at whether there's an upside to discretion and whether there are ways to kind of improve upon the existing use of discretion. Okay. So again, discretion is equal to both soft information, which is great that we use it, plus individual noise, okay? And we asked, is there a way to make human ratings more predictive and less noisy? We face a measurement challenge, which is ratings both affect and predict future bank outcomes. Before, when I showed you that IV, we isolated the causal effect of noise. Okay? Here we want the overall predictive power of discretion, both the good stuff, the soft information, and the bad stuff, which is noise. Okay? So we're going to look at whether overall the discretionary component of ratings, that predicts outcomes that are unlikely to be affected by the ratings themselves, such as the future performance of loans that were already made before this rating is decided upon. And here's what we find. So we're going to look at the relation between examiner level discretion, separated into 3 buckets, whether the examiner exercises low, medium, or high discretion on other exams. And what we find is, in all cases, when the examiner gives a higher rating than predicted using hard information, that rating really does predict future bank outcomes in the direction that we would expect. Okay? So examiner discretion seems to be effectively using soft information. However, among examiners who exercise very high discretion compared to those that exercise a medium amount or a low amount, they are not necessarily offering better predictions. Here, they're just introducing more noise. And then finally, we can compare actual ratings to machine-driven or constrained ratings in terms of their predictive power. Okay? And what we find is if we were to reweight these ratings, so we still allow human discretion, but we prevent these examiners from assigning a 50% weight to management, instead force that weight down, what we get overall is higher explanatory power for future bank measures of health as measured by AUC, okay, while simultaneously reducing noise. So I'm just out of time. Let me briefly conclude. What we're showing here is human discretion can be helpful. We actually reject some of the conclusions in the algorithm aversion literature, which has made a kind of a strong claim, in my opinion, that human discretion or human ability to predict outcomes is complete garbage, okay? So there is some real signal here. But however, we point out that putting bounds on human discretion can be useful for predictive power, and especially because of the way that there's such a reliance on a weighting scheme. So if you were to put constraints on the weights, that can retain some of this predictive power while constraining the noise. And further, I think this highlights the importance of not just trying to come to consensus on individual issues, but having an explicit discussion about what are the appropriate weights on these various issues. Okay. All right, thank you very much. I look forward to my discussant's comments.
The first discussant is Rafael Repullo. Rafael, please.
Well, thanks very much. I'm very pleased to be here. It feels back home. This is a very nice paper, and on an area which deserves a lot more research. Now, this is about basically the role of hard and soft information in decision making. So hard information, basically think about accounting statements. Soft information is what comes from these supervisory assessments. Now, the outcome that is analyzed in the paper is this US CAMELS ratings, which is a number between 1 and 5. Now, what is important is the key in this paper is this exploiting these characteristics of bank supervisors in the US. They are rotated periodically across banks, and they exercise wide discretion. Now, the question is, what is this discretion doing? Well, I mean, the questions that the paper addresses is first, how can we measure discretion? The second is, does it matter for bank behavior, in particular from an ex-post perspective in subsequent decisions on, say, capital and lending, and also ex-ante in prior decisions on capital and lending. And finally, is examiner discretion good at predicting deterioration in performance, like, for example, in terms of non-performing loans and delinquency rates? Okay. Now, the institutional setting, I will be very brief. US banks undergo these examinations on a regular cycle, typically every 12 months. Excluding the largest banks, state and federal agencies are involved. Banks are rotated across examiners, and banks are rotated also across agencies in alternate years. There is concurrent exams by both agencies, and in which case they issue separate reports, and therefore we can measure disagreements in those cases. Now, this has already been said, the CAMELS 1 to 5, 5 is bad, 1 is very good, and they also have the benefit of exploiting each of the 6 components as well as the composite rating. Data, this comes from this wonderful database that covers 98 to 2020. They look at bank identity, lead examiner identity, and the exam date, and then they get all the ratings together with the components. They also use the call reports for computing, getting capital and leverage, returns on assets, non-performing and delinquency ratios. Now, the final sample contains 2,400 lead examiners and 14,000 examinations, so there is an average of 6 exams per lead examiner. And the distribution of the ratings is that 1 and 2 are the most frequent, and then, but of course, 3 is 10% of the ratings, and now 3 is the alert rating for supervisors. What are the main results going back to these research questions? How can we measure examiner discretion? Well, suppose that we define RIJT, the rating by examiner I of bank J at day T. Now, we can try to predict this rating by using observable characteristics that I think should be dated T-1, And then we can define the directional discretion as the error in this prediction, the rating minus the prediction of the rating. Now, absolute discretion would be just the absolute value of the directional discretion. Now, these measures can be aggregated at examiner level, so we can see that whether a particular lead examiner has high or low directional discretion. Now, this is the distribution of discretion. You can see that is centered at 0, the directional discretion on the left part of this panel. And that one thing that you can notice is that it has large variance here. Okay. What about this discretion matter for exposed bank behavior? We are looking at the error term of this prediction. And what they show in the paper, very interesting results, is that higher Tier 1 capital ratio and lower loan growth is associated with this directional discretion. On the ex-ante bank behavior, what they do is they look at examiner uncertainty at the state level, looking at the average of absolute discretion over the last 5 years. And what they show is that this is the anticipatory response. Both proxies lead to higher Tier 1 capital ratio and lower loan growth. So they seem to matter in terms of bank behavior. And finally, in terms of predicting future performance, what they show is that directional discretion leads to higher ratings, which is bad. Remember, 5 is bad. Higher non-performing loan ratios and higher delinquency ratios. So they are informative about so there is value in the soft information, and it has an effect on bank behavior. Now, there are other results which I think are very interesting. The examiner rotation is random, as was presented. If you regress the composite rating on its components, the highest weight is in the management rating, which is, of course, the most subjective component. But let me now, and there are some other results that I think are very interesting. For example, in the smaller sample of concurrent state and federal ratings, the disagreement is common, and this is especially the case in the management rating. Okay, now, I will focus my discussion on 2 parts. First, I want to review the conceptual framework that is in the paper, and then I'll have a few brief comments on the empirical results. On the conceptual framework, I think that they state this as a goal to distinguish between informative variation arising from soft information and unproductive variation arising from noise. Well, I really have a problem here with this statement, because I think that, I mean, I may be wrong, but I think that this is not possible, since soft information is a noisy signal of the safety and soundness of the bank. So the two things go hand in hand. So how do I think that, and also in the conceptual framework in the paper, they make this reference to the unobserved optimal rating decision, but it's not clear to me what you mean by optimal. And then they look at the examiner rating as a random deviation from this decision. So it's not clear to me how is soft information incorporated into this framework. So what I'm going to do is to present you briefly an alternative framework that I think is more suitable to the way in which the empirical results are presented. Now, let us define the Z as being the underlying state of the bank, which is a latent variable. X is going to be the hard information, and S is going to be the soft information. So just for simplicity, assume that after suitable normalization, all these things are normally distributed random variable 0, 1, 0 mean 1 variance, unit variance with the corresponding correlations. Now, bank rating is basically the expected value of the underlying value of the solvency of the bank, conditional on both the hard and the soft. That's what the supervisors do. What we can do as econometricians is to predict bank rating using the X, the observable hard information. And then, of course, you can actually compute by the properties of normal distributions. It will be very similar with linear projections. The R is going to be just a linear combination of the hard and the soft. And the prediction is going to be just, again, a function of the hard information, because that's the only thing that the econometrician observes. Now from here you can define directional discretion as the gap between the R and the R hat. This is the error term, which has an absolute discretion, would be the absolute value of these two things. And then note that we have, of course, the expected value of directional discretion is equal to 0, which is what was shown in the previous figure. I think that this kind of framework is very nice because it can incorporate examiners' biases, as noted in the seminal paper by Agarwal, the inconsistent regulator, published in the QJ in 2014. Federal examiners are tougher than state examiners, and then you can add a bias term in the rating, and can be high or low, and then you can show that the expected value of the directional discretion would be lower for one of the two examiners. Okay, so summing up, I think that this alternative setup provides a simpler and better framework for understanding the empirical results in the paper and the role in which soft and hard information are combined into these ratings. Okay, quickly, empirical results. Now, Camel's ratings are discrete. They go from 1 to 5. So the determinants of going from 1 to 2 or 2 to 3 are different. And also going from 2 to 3 to 3 to 2 is obviously something which is very different. So I think that I would argue that it's much better to use discrete choice models throughout the paper. Second comment is that data on directional discretion could be exploited more. I mean, they use, look at the correlation with observables beyond the state and federal. For example, there are different types of federal examiners, the Federal Reserve, FDIC, OCC. You can have other types of observables to see what is behind this directional discretion. Now, there is this claim in the paper that greater directional absolute discretion only adds noise without improving forecast accuracy. I mean, I think that this claim should be toned down because the difference in the regression coefficients are only marginally significant. And also, I think because note that noise encourages this prudent bank behavior. So I think that there is this ex-ante benefit of having some sort of noise in terms of and I have a paper on that point. So let me just conclude. I think that the paper addresses a novel issue with an amazing database. There are many interesting results. More work can be done along these lines. I think that more work can be done on bank supervision generally. I think that the intermediate goal for policy would be to improve the design of supervision, but there would be a final goal, of course, to conduct some sort of welfare analysis of bank supervision. And let me just add two minor suggestions. One is for the title of the paper. I think that I would suggest to replace discretion in regulation by discretion in bank supervision. I know in the US the two things are mixed together, but this is the time in which we can start distinguishing between these two terms. And finally is a major suggestion for the ECB, and Claude is here. So I think that you should start exploiting the SSM data on bank supervision like they've done in the US, and in particular, for example, the effect of the composition of the joint supervisory team. So thank you very much.
A perfect transition to our second discussion. Claudia Buch, please.
Yes, thank you very much, and thanks a lot to Luc and his team for organizing the conference, for giving me the opportunity, and I'm also speaking always, on behalf of the whole team. I will provide you with some actually evidence from our own work to have me here and also contribute a bit of a practical supervisory perspective, and I'm particularly grateful from that perspective that you put a question mark to the title, the next financial crisis. So of course, we do everything that we can to keep that probability as low as possible, the impact as small as possible. So actually, I had read the paper before I was actually asked to provide comments here, because I think it is indeed extremely interesting and relevant for our own work. So I fully agree with what Raphael said, that we need to do more work on assessing supervisory effectiveness. So what I would like to do here is just, my summary slide is just one page, so I will be very quick, but then also explain a bit what we currently do in the SSM, concretely on assessing supervisory judgment, but also more broadly, I think what's important is that judgment is not just replacing rule-based decision-making. It also requires, time for the supervisors to look at new trends, forward-looking assessments. So we also do a lot to streamline our procedures precisely to give that time and space. But just a quick summary of the results of the paper. So yes, supervisors apply judgment, and as we've seen, the ratings reflect discretionary assessments. Judgment has real effects. We've seen the effects on capital and lending. I'll comment on that later on. And then judgment improves predictive power. So there's always this balance to strike. So how rule-based do we want to be, then ignoring potentially interesting forward-looking information? But of course, judgment can introduce noise, has been discussed. So we need to find a way to balance these two elements and make the best out of the rule-based component, the judgment component. I think the paper makes a very important contribution to this literature by providing us with a framework how judgment can be assessed, and we should do more of this work. And I felt a little bit reassured in how we're using judgment in the SSM, because we use constrained judgment. I think it's exactly what also this paper is arguing for. So this is a little bit small print, but just to say that we also have a scoring system in the SSM, the so-called SREP scores. And if you just want to focus on the second line from the bottom, it's basically 4 elements that enter. That's business model, the governance of the banks. As we know, this is crucially important, in particular in a very uncertain environment where we just need, good judgment, good management of risks, and that requires good governance. And then, of course, we look at risks to capital, and also we assess liquidity risks. So all this goes into a scoring system. I won't go into the very detail. Perhaps a little bit different from the US, this also has implications then for quantitative capital requirements, so the Pillar 2 capital requirements. There's not a one-to-one translation from the scores to the capital requirements or qualitative requirements, but this is an important basis. In our case, the range is from 1 to 4, and for the grades 2 and 3, we also have qualifiers. But as I said, what's important here, we really have 3 phases of the SREP, so the supervisory review and evaluation process of that assessment, which is basically what I said earlier, a process of constrained judgment. So the supervisors start with collecting lots of information, including from banks' own internal risk assessment systems. So this is the data gathering phase. Then there's an automatic score being calculated, but then in the third phase, supervisory judgment comes in. We're currently reforming the Peydró methodology. So how do we come up then with the capital requirements? And there's I will show you later on, there's 2 elements where judgment comes in for the overall score and also for the individual elements. But this is, the judgment part is already in the current framework. So my comments, not sure whether this is, the title is a bit broad, what determines the choice between rules and discretion, but the 2 points I would like to make here, and I think also that's where the paper maybe could go into some more detail, because you have a really nice data set, not just in terms of the granularity, but also of the time period covered. I think it's 98 through 2020. So you have a lot of structural change, regulatory changes in this period. It would be interesting to see whether the results would differ if you would run the regressions over different subsamples. So why do I think this is important? Well, in particular, at the current juncture, we have a lot of uncertainty. Geopolitical risk is one element, actually one priority for the SSM. We have lots of structural breaks. Just to give you one example, we had major shocks hitting our economies, COVID, the energy crisis. Large parts of these shocks have been buffered by other policy areas, fiscal policy first and foremost. So actually the real effects of these shocks have not really hit banks' balance sheets, which is of course good news, but this is something we need to take into account when we do a forward-looking risk assessment, and also in that sense scoring of the banks. So what I'm saying here is that of course the rule-based component of whatever we do is becoming less and less reliable in an environment with uncertainty and structural change. And it would be interesting if the authors could explore this a bit more, whether their results have anything to say to this debate. And then, and I think it was interesting, you kind of mentioned this in passing, so how transparent do we want to be as supervisors about the methodologies we use? And there was a dedicated strategy in the SSM to increase transparency, to publish what we do. There's lots of guidelines around it, but of course we can't publish, or we can't really, there's no quantifiable effect of the discretionary component. We can say where discretion comes in, but this is not something we can publish. So I think it would also be interesting if the paper could inform that debate a bit. Second point, and this actually goes to what Raphael said, how to evaluate the effectiveness of supervision. And I think the paper provides a great empirical framework for doing this. So what is the intended, what are the unintended effects of judgment? And we have done some work, or I should actually be more precise. So these are the colleagues Gabriel Borbecha and Silvio Prica, who have done work with our SREP scoring, also showing how judgment is used currently. And as in the US, yes, the supervisors adjust the scores to stabilize the outcome, so they don't just use the automatic score. And they take into account the macro environment. They also take into account the supervisory priorities that we are setting in a very structured way. So this is reflected in the scores. I think we don't just need an empirical framework to identify all these things, but I think, and this is where also Raphael's work is so important, we also need a theoretical framework. How do we want to assess, whether the judgment that is being used, whether this is positive or negative in terms of the welfare implications? So the paper finds that discretion makes banks more conservative, which would enhance resilience. So is it, I would tend to say, and this was also mentioned as a supervisor, this is a positive outcome. But of course, we need to assess this, and we need to continuously also work on understanding the use of judgment, and we need to use the framework that has been presented here. And then my final comment is on how to specifically exercise judgment. So judgment is a very, general term, and there's a few things that the paper suggests how judgment can be used without introducing judgmental bias. So these are guidelines. As I said, we are using those moderate constraints to preserve flexibility but still enhance consistency. And maybe even algorithmic tools can support rather than replace supervisory judgment. So as I mentioned earlier, this is even more difficult to read than the previous slide, but all this will be published so you can look at it. We do have a new methodology for the P2R, which introduces two elements for judgment in this here on the right-hand side. It's simpler than the current one, and it has two elements for judgment in step 2 for the individual scores and for the holistic adjustment. All of this is being benchmarked within the SSM, so we do a lot of work to make sure that also the scoring and all this is used consistently. So to conclude, supervisory judgment is essential. As I said, this is not replacing rules and analytics, but really trying to make sure that also forward-looking information is integrated into what we are doing. Both qualitative and quantitative aspects are important. Generally, in our supervisory judgment, we need strong governance, we need strong financial and operational resilience. And I think judgment is particularly important to also adapt to the changing risk environment. So this is what we're doing with a much broader set of reforms of the SREP, to really make sure that supervisors have the space, the capability also to use analytical tools to exercise this judgment in a useful way. And finally, but this holds for the whole, we have a big debate about regulation and supervision. I think we really need to be careful to take conclusions from that debate. We need to evaluate, we need sound rigor analysis, but this is exactly what this paper is about. So thanks a lot again for having me here and allowing me to discuss this paper. Thank you.
Kelly, would you like to take a couple of minutes and address some of the comments?
Sure. Well, thank you very much to both my discussants for the extremely helpful suggestions and comments. All of what you said is very well taken. Let me start with Raphael's comments. So first, thank you for the specific econometric suggestions. We'll definitely take into account, use more discrete choice models, et cetera. Thank you also for proposing this kind of alternative modeling framework. We'll consider that very carefully. I just need some time to absorb it, but I think kind of using this correlational matrix structure could be very useful. Just in terms of what is soft information, can that be represented by a variable given that it's open to interpretation? I think what we have in mind, this might also be in your model, is we think of soft information as a true measure of bank quality that is attached to a case rather than to a decision maker. So soft information is a latent variable that exists. However, for us to be able to access it, each of us seeing that soft information will see S plus our own individual error terms. That's kind of what we have in mind when we think of soft information. And actually, both discussants had talked about, can we reduce noise? And then importantly, Raphael pointed out, do we want to reduce noise? Because he has a model which I find very intuitive, which is the more noise you have, you actually can lead to more conservative bank actions, which is perhaps what we want as supervisors or as part of the bank regulation system. It just is an open question how much noise then we want, because this is a type of noise that I mentioned earlier is quite difficult to control, unlike an opaque stress test, okay? Because neither side knows exactly where this noise is going to lead. And further, this is a type of noise that ex post, we have banks in terms of their lending and capitalization just bouncing around each year because of which new examiner is assigned. So there are costs of this noise. It just needs to be balanced with perhaps the benefit of noise in terms of leading to conservative actions. Claudia also asked about what more we could do in the data. We'll do more of those tests. But one thing that we did look at in terms of, we have a long sample period, is we look at before and after the great financial crisis. And what we find is after the financial crisis, if anything, discretion slightly increased, and also the weight on this most discretionary component, which is management quality, has further increased as well. So this is if anything, trending up. Okay.
We take some questions from the floor. Luc, here in the front.
Luc Laven, ECB. I wanted to ask about what you call noisy supervisors. So are these truly randomly distributed across the population? Or, which I think you hinted at, you basically end up, this noise comes from you have a bunch of tough supervisors and you have the softies out there. If it's the latter, I think most of us would agree that the problem that we have faced with supervision over the years is that there are too many softies out there. And so maybe then the way you set this up in this more symmetric fashion would need to be rethought a little bit. I just wanted to have your sense on that. Now, in terms of getting to the solutions, which is the most important aspect, of course, that also Claudia asked about. I mean, at least in most other similar settings, unlike the one, the Kahneman setting, where you seem to know it's the 5 years, right? But in most cases, let's say you remember from your school exams or something like that, you have an oral exam, you have two examiners, one after the other, they seem to disagree, you could contest. So is there any, at least, discussion in the US around that? I mean, especially if fundamentals haven't changed and from one day to the next your rating suddenly changes, can this be challenged? That would be an easy solution, at least, in addition to just fixing the weights to 20%.
I see. Let me take the first part of your question, which is what accounts for a lot of this variation. A big part of it is just examiner fixed effects. So that would be, some people are just predictably more tough than others. When we look at our second measure, which is absolute discretion, so that's among people who are equally tough on average, we still do find substantial variation in some people, are just more difficult to predict based on the hard information in either direction. I think that second component is approximately equal in magnitude. So they're both there. It's kind of like, in the academia, we have tough referees, lenient referees, and then there's some people who aren't particularly tough or lenient. They're just hard to predict. With respect to your second question, that's very interesting. I am not an expert on kind of how successful kind of pushing back on a rating is. Does anyone in this room know whether it is possible to contest these ratings? Yeah.
I don't have the answer for the US. I mean, of course, in Europe, we also generally, about all our supervisory decisions, there's a right to be heard process. Internally, there's a benchmarking process. So I don't know, we have a second line of defense which is doing that benchmarking. So, but that would rather be a question to you whether that's the same in the US. I'm not an expert on the details there.
I will check with perhaps our Fed co-author, but I think, Amir just says no. So there's one answer. The other thing is, I believe we're looking at the rating, whatever was finalized after possible back and forth. So even in that final rating, we're finding this kind of strong, at least examiner fixed effect and absolute discretion in these ratings.
Levine, Hoover. So I think it's a wonderful paper. I've seen it presented a couple of times. It's excellent analysis on an under-examined area in finance. And my question is not about the research per se. It's about, it's just a difficult to understand evaluation of how can the US supervisory system be this way for so long. And let me give you a sarcastic story. Let's say you have a bank examiner in the US, goes to a bank. And what the bank says is, here's how we evaluate our loans. We randomly choose a loan officer. They go to the firm, they evaluate the loan, they give us a number, and then we decide. Okay? The bank examiner would almost certainly say that's bad management, because what would typically happen, you'd expect in a bank, is that the bank would have examiners that are very close to the bank that obtain the soft information that comes from these ongoing relationships. Then this type of information would come back to a review process within the context of the bank. They would review this as a way to sort of sort out the random component that would come from individual bank examiners, and in that way try to distill the really good part of the soft information, combine that with the hard information, and then come up with an evaluation of whether to make a loan. And so it's hard to understand how an entity that would expect that of banks wouldn't expect that of itself. And I'm wondering, given your interactions with the Fed, is there any assessment? Now, the one argument, and this could be, is that it never dawned on them, and your paper is sort of a way of illuminating this shortcoming in how they're doing evaluations.
I mean, it's a great question how this can be allowed to take place. I will say, I think our paper matters for bank supervision, but it has broader kind of implications. So there's parallel work on judges. And in terms of the variation in judge fixed effects, it's terrifyingly large. Some judges grant parole at 80% rate, other judges grant parole at a 20% rate, random assignment to the same set of cases. So this type of dispersion is not unusual. Like, the reason why we can look at bankruptcy outcomes is the judge fixed effect in terms of who favors Chapter 7 versus 11 or 13 is also huge, okay? Which again, great for, empiricists, bad that these outcomes are so randomly assigned to cases. Not specific to banking, but I think part of why this could be allowed to occur is there is a sense of overconfidence among professionals in which, I may not want all of you to have discretion, but I want to maintain my own discretion. And what we do find in our sample is that the amount of discretion that these examiners exercise actually slightly increases with their experience. So it's kind of, they have more confidence in their personal judgments as being kind of more relevant than the hard information.
Jean-Charles?
Thank you very much. Rocher, Toulouse School of Economics. So it's a fantastic paper, I enjoyed very much, and I think your setup is adapted to study several possible extensions. So let me give you 4 quick comments or suggestions. One is committees. What would happen if the decisions were made by several people instead of one? Would this reduce the noise? Second, complexity. There is a lot of discussion about the excessive complexity of bank regulation and ideas to simplify it. So suppose in your model you reduce the number of criteria. Would this lead to more or less biases? Third, incentives for supervisors. Supervisors do not always do what they think is best for society, but what is best for their own careers. And so the idea of having a long-term relationship between supervisor and banks is not necessarily good in terms of possible collusion. So I believe that if you introduce, in particular, if you evaluate the performance of supervisor, is it something that is done in the US? I think it would to change the incentives of supervisors. And finally, there is an old literature on bank bailouts, the notion of constructive ambiguity. This idea, which I don't like at all, that if you decide randomly whether or not you will bail out the banks, this would increase the incentives of bankers to behave. Would you have something like that here, in the sense that discretion can improve the incentives of bankers not to take too much risk?
Thank you. I've taken notes. Those are 4 great suggestions. Thank you.
I'll take 2 more questions. Paula here.
Paula Sapienza, Hoover. I love the paper, but I actually wonder, besides the effect, the fixed effect at the level of the individual examiner, whether there are also bilateral biases, which I think it would be actually very interesting to study within the ECB, given that you have these multiple countries. There is strong evidence that even within multinational banks, the way in the European setting, the way they evaluate the bond allocation by countries in different countries is presenting bilateral biases. And so in some way, I don't know what other variable you have about the specific, going back to Kelly, in this setting, like to what extent, you come from a different areas and, there are differences on the identity of the people and so on. But in the European setting, I think this would be very powerful. I assume that, and there was some discussion early on about how you form those teams and how much people come from different countries and so on. And I think that would be a fascinating topic.
I think it's a question to both Kelly and Claudia, so maybe you can take turns.
Just briefly. Oops. Yeah. Just briefly, because also the point of incentives was being mentioned. So this is why we have, first of all, the benchmarking in place, where an independent unit within the SSM looks at all the decisions being taken, benchmarks, discusses with the teams, and that is I think very powerful. In terms of the nationality component, so the joint supervisory teams, first of all, we also have a rotation so that you can only be in that team, depending on whether you're a member of the team lead for a certain period of time, and the team lead can never be from the same country as the bank. So we do have the ECB that's in the lead, and we have the national competent authorities in there, but it's important that the team lead is always from a different country. So these are mechanisms to also deal with potential incentive issues. Yeah.
Kelly?
I think bilateral matching could really matter. I think it's generally been shown in hiring or among loan officers that if there's greater similarity between the decision maker and the candidate, you can extract kind of more precise information, which also means that if you're, let's say, a case or candidate from a smaller demographic group, then you're less likely to be matched to a decision maker who can extract your soft information. And that can put you, depending on the context, at an advantage or a disadvantage. Yeah. So it can definitely matter.
A last short question from Amir.
Thanks, Emil Werner, MIT. It's a fantastic paper. I wanted to get your thoughts on the striking result you find on the role of management. There's actually kind of a lot of discussion now about whether maybe management should be, play less role in the CAMELS rating. Some people argue that it should be removed. But if you look at, there's been, over the past 100 years, the OCC, the Fed have done a range of evaluations of why banks fail. And very often, like the OCC, for example, in one report says 90% of bank failures are due to kind of fundamental management issues. That's sort of the root cause. Now, one story might be that humans just love to blame other humans, and so maybe that's kind of an ex post rationalization. But another view is that maybe this management component is actually very important for understanding the risk of bank failures, but it also just happens to be the one that's really the most difficult to judge and the most subjective. And so I wonder, kind of in your framework, how do you think about that trade-off? That maybe it's a variable that matters a lot, but the most difficult one to assess.
I don't think we don't find significant differences, which is not to say that management isn't very important, but basically the discretionary component of the management rating doesn't seem to predict future measures of bank health more so than the other measures. Okay? So we don't find strong evidence that management matters more than, let's say, capital adequacy or the quality of assets, et cetera. But it certainly could matter more for the failures. We don't have enough of a sample to really study that. So yeah, I don't think we get to conclude from our research that it is a mistake to put so much weight on management quality. I mean, that could really be a determinant of bank failures, but it certainly leads to a lot of disagreement.
I suggest we continue discussing over coffee. We now have a coffee break until 11:45. Please come back for a very exciting policy panel on the next financial crisis, big question mark. And now join me for a round of applause for our speakers. Thank you.
Good morning, ladies and gentlemen, dear colleagues, and welcome to the concluding panel of this conference. So over the past 2 days, we have discussed a broad range of risks to financial stability, focusing on both banks and non-banks, and asked how monetary policymakers and regulators should act to contain them. And together with my two distinguished panelists, we will now put all of those insights together and ask, what could the next financial crisis look like? Financial crises are a recurrent phenomenon, as President Lagarde reminded us yesterday, and they tend to be deeply disruptive for our economies. The last global financial crisis started almost exactly 17 years ago, on the 15th of September 2008, and many of us remember vividly not only the sequence of events, but also their severe consequences, including the subsequent balance sheet recession, the European sovereign debt crisis, and the low inflation, low growth period. Some economists, including our keynote speaker Raghu Rajan, and the authors of the first paper this morning, have argued that monetary policy responses to this latter episode may themselves have given rise to new financial stability risks. However, in spite of repeated episodes of severe financial stress in recent years, we have been spared from another full-blown financial crisis. But there were at least 2 instances when we may have been close to another financial crisis, serving as an important reminder of the fragilities inherent in our financial system. The first instance was after the start of the COVID-19 pandemic in 2020, which exposed the fragility of financial markets as investors flew to quality in a dash for cash. At the same time, we witnessed how non-bank financial intermediaries amplified the market turmoil through fire sales. Central banks and governments intervened massively and thereby successfully prevented another global financial crisis, as Marie's paper illustrated. But this also meant that risks were transferred from the private to the public sector, for example, through broad-scale guarantees to corporates, which shielded the banking sector from credit risks. At the same time, this prevented a credit crunch, which could have further deepened the macroeconomic downturn. The second episode of financial stress that I would like to mention occurred at the time of the historically steep hiking cycle in many parts of the world in order to fight the unprecedented surge in inflation. Especially after the prolonged period of low interest rates, rapidly rising rates led to the materialization of interest rate risk, a topic that we also discussed yesterday afternoon. Bank runs at Silicon Valley banks and other institutions in the United States reminded us of the traditional fragilities in the banking system. The fact that the euro area was largely shielded from similar events can also be seen as a compliment to our regulators and supervisors who managed to avoid a crisis in these very challenging times. Despite their differences, these episodes share common features that resonate with historical experience. Financial crises are often preceded by accommodative policies, excessive credit growth, liquidity and maturity mismatches, high leverage, deregulation, and financial innovation. Similarly, liquidity mismatches, high leverage, heightened pro-cyclicality, and a lack of macroprudential regulation have featured prominently in periods of stress in the fast-growing NBFI sector. In addition, its growing interconnectedness with the traditional banking sector raises the risks of spillovers and an amplification of shocks. And these risks are compounded by the ongoing wave of financial innovation. The rapid rise of crypto assets and so-called stablecoins might reintroduce familiar fragilities in new forms through volatility, opacity, liquidity mismatches, leverage, concentration, and contagion. So far, we have not seen how these new asset classes behave under severe market stress and how they could be linked to the traditional financial sector, leaving open questions about their potential to exacerbate financial instability. Today, we're facing an environment of heightened uncertainty. From escalating geopolitical tensions to lingering fiscal concerns and increasing doubts about international collaboration, the global financial landscape has become not only more complex, but also potentially more fragile. While the patterns have tended to repeat themselves, the precise way in which financial instability may play out is unknown. But we are lucky to have with us two distinguished speakers bringing a wealth of experience and complementary perspective to help us bring some light into this. And I would like to start with Klaas Knot as a first speaker, who until very recently was the president of the Nederlandsche Bank, the chairman of the Financial Stability Board, and most importantly, a dear colleague in the Governing Council. He's also professor at the University of Amsterdam and honorary professor at the University of Groningen. Klaas is known as a sharp thinker with a keen interest in financial stability, which he defended not only in the euro area, but also in the international arena. So Klaas, thank you so much for being with us today. So maybe you can tell us, what do you see as the likely cause of the next financial crisis?
Well, thank you very much for this introduction, Isabel, and it's a big pleasure to be back in Frankfurt and to find out that access to the building is still there. And so I made it, I'm here. I'm here to talk about actually quite an interesting subject. Where is the next financial crisis going to come from? Because we all know, since Raghu, I don't know whether Raghu is still with us, I saw him early this morning, but anyway, since his 2005 Jackson Hole speech, we know that risks always go somewhere and that you have to ask the questions, where do they go actually? Now, in trying to answer this question, where might the next financial crisis be coming from? You already hear that I'm reformulating in a slightly more cautious way. I think it behooves us to first look at what are actually what have been the major trends that have shaped financial intermediation over the last few decades, and what I will argue have also changed the nature of systemic risk in the financial system. And I would start by saying, first of all, it is the emergence of public debt. So more and more credit is now going to public debt. There has been some form of crowding out of private debt to public debt. We saw this morning, by the way, that within private debt, there has been a crowding out of corporate debt by mortgage debt, but that could be subject of another other discussion. But I think it's important to take away. So global bond markets and developments in global bond markets have become much more important for financial stability because of this trend. Second trend is the trend, you already mentioned it, Isabel, away from banks to non-bank financial intermediation. Non-bank players are hugely important in bond markets, in other bond markets. Hedge funds that are quite highly leveraged, but also traditional insurance and pension funds that tend to have quite correlated investment strategies, which is an issue in and of itself. And that also means that if you think about systemic risk, that if you move from banks to non-banks, systemic risk also is more now an add-on to liquidity risk rather than to credit risk. So traditionally, we've always been strongly focused on banks and credit risk, but in non-banks, it's primarily about liquidity mismatches. The examples you mentioned were clear examples where there were spikes in liquidity demand, and non-bank financial entities were actually hastily trying to reduce their exposure to these mismatches. And that led to sort of fire sales, correlated fire sales that could only be countered by central bank intervention. Also, NBFI is of course more cross-border in nature. Markets are even more interconnected than banks were. So that all leads to the conclusion that probably most of the financial stability risk in the spectrum are coming from outside the banks. I don't want to completely discount banking risks, and we will probably also come back to that later. But when I think about the main sources of risk that I see at the moment, I think primarily about NBFI, and let me elaborate on two concrete examples. One is private credit and the other one is stablecoins. Private credit has grown very, very rapidly over the last few years. And that is a potential risk to financial stability. In the meantime, it's a 1.2 trillion US dollar market. 87% of it is originated in the US, only 6% in Europe. But also in the provision of private credit in Europe, some 30% of that is originated in the US, actually, by US suppliers. Now, private credit, by its very name and sort of manifestation, is, of course, more opaque. It's more illiquid, less liquid than sort of credit through the banks. The sector is also highly concentrated. So you have 10 funds, mostly US, of course, that account now for a third in total global lending. And for instance, if we look at the Herfindahl X for loan origination within private credit, that is 20 times the Herfindahl index for loan origination within the banking sector. Just to illustrate the amount of concentration that is there within private credit. Thirdly, private credit is also concentrated on a very few sectors in the economy. And for instance, business development companies, is big, financed by private credit, leverage nearing 90% in these loans. And so that raises the risk of pro-cyclical deleveraging. For the last 15 years, we've been recapitalizing the banks in order to turn the banks from shock amplifiers, which they were in 2008, 2009, into shock absorbers, which they were in the crisis of the last 5 years, the Dash for Cash, Archegos, the UK LDI, and what have you. But unfortunately, such is not the case for private credit. And private credit has never witnessed an economic downturn. For banks, when credit deteriorates, they have workout procedures. They have specific departments that sort of deal with fallen angels, etc. If you start talking to providers of private credit, they have nothing of that kind. So what I really worry about is significant procyclical deleveraging, as there is not the same amount of resilience in private credit than there is in the banks. And then we know, of course, that when credit starts to deteriorate, then you have to move credit off your balance sheet. And that is the procyclical deleveraging that I would possibly worry about. Second point is stablecoins. That's also a recent development. Now, before going into the risks, let me also say there's a tendency in our circles to be a little bit sort of bashing stablecoins, etc. And many of us are, of course, coming from advanced economies where you have a sort of sophisticated banking system, you have sort of fast payments and well accessible, cheap, you can go anywhere, etc. But let's not forget there is another part in the world where cross-border payments within the banks are laborious, are expensive, are non-accessible, etc. So there is a business case for stablecoins in these countries, in those parts of the world. So it's not just about risks and negativity as far as I'm concerned. But nonetheless, I was asked to talk about risks and possible next financial crisis. Of course, stablecoins are a little bit like money market funds in terms of structure. So the stability of stablecoins depends very much on the stability of the underlying assets. And the underlying assets, well, much of it is sovereign debt. I mean, the biggest two stablecoins are also the biggest parties now in the auctions of fresh sovereign debt. So Tether is the biggest party when sort of the US issues treasury debt. Then Tether is the #1 absorber of that public debt. And we know that there have been liquidity runs and liquidity squeezes in public debt, in sovereign debt markets. And then, of course, you don't have to have too much imagination to think about the possibility of a run on a stablecoin, because stablecoins are not transparent, are opaque. You don't know whether the reserve asset requirement is really met at each point in time. Stablecoins are also used to settle, let's say, transactions in crypto assets, in risky crypto assets. Well, they also bring about a lot of volatility. So there are at least two sources of possible shocks in this stablecoin structure that could lead to unease about stablecoins and could lead to a run, where of course there is not such a thing as deposit insurance to sort of instill confidence at these times. So these would be I could probably talk about a few more, but these would be my sort of two issues that I worry about most.
Thank you very much, Klaas. Just one very short follow-up question on this. I mean, so we know that stablecoins so far play a very limited role in Europe. So what about private credit? What is how relevant is it quantitatively in Europe? Do you have the numbers?
Yeah, well, 87%, as I said, was originated in the US and only 6% in Europe. So it's still a bit smaller in Europe, but it is concentrated in a couple of sectors. For instance, the healthcare sector, where you have a lot of private credit, and these business development companies. So in Europe, it's not so much yet the size, it's more the concentration on only a few sectors.
Okay. Thank you very much. So now I hand over to my second panelist, Pierre-Olivier Gourancha, who is the chief economist of the International Monetary Fund and a professor of economics at the University of California at Berkeley. Pierre-Olivier is one of the most influential international macroeconomists who has consistently published in the very vast academic journals. And we are very much looking forward to hearing your perspective on what the next financial crisis could look like.
Well, thank you very much, Isabel, and thank you for inviting me. And I come with a background that is maybe more on the macro side than on the financial side. So I will offer remarks that complement what Klaas has mentioned by highlighting some of the risks also on the real side of the global economy. But I would start to say that predicting the next crisis is kind of difficult. My former colleague Barry Eichengreen used to say, I can tell you where the next crisis is going to be or when it's going to be, but I cannot tell you both. And I think that's probably right. So I will not attempt to do that today. I will highlight four main risks, some of which also have been mentioned by Klaas. So the first one I would mention is fiscal fragilities. So I'm concerned, we at the fund are concerned that fiscal fragilities have increased since the COVID crisis, and that they could threaten macroeconomic stability, but also financial stability and even monetary stability, and so amplifying financial risk as well. So let me explain. So first, we've seen the increase in public debt. We've also seen the increased pressure on long-term bond yields. We've seen the yield curve steepening. If you look at US Treasuries, if you look at European government bonds, if you look at UK gilts, if you look at the Japanese government bonds. So the yield curve has been steepening around the world and for most advanced economies. This is something that's probably been reinforced by quantitative tightening that basically releases some of the bonds into the market that have to be absorbed gradually, but still have to be absorbed. And so you can imagine that if there was a sudden loss of confidence in sovereign bonds, especially in countries that have a little bit more precarious fiscal position, then that could be something that leads to financial instability, leads to price adjustments, leads to disruptions in financial markets, and then financial volatility. Now, one worry we have is that there is a temptation in situations where the fiscal outlook is a little bit more precarious. There could be a temptation in some parts of the world to exert pressure on central banks to lower interest rates. That's something that we see in a number of countries, by the way, in order to maybe contain debt servicing costs. And so I want to be very clear that from our point of view, this would be a terrible mistake, and I think that this is probably a view that is shared by many of you. Central banks are not free to set interest rates as they please. They must do so in order to achieve their mandate, which includes price stability and in some cases full employment. And they therefore have to stay close to whatever is the neutral rate, however difficult it might be to estimate that. So any attempt to deviate from this, especially on the lower side, would create more price pressures that would be priced in the bond market. Therefore, it would be self-defeating, would not necessarily increase or lower the financing cost for government. It would increase risk premia, would increase volatility, would increase inflation pressures, and would also destroy one of the key assets that central banks have, which is their reputational commitment to keep and achieve price stability. So it's very clear that for us, this is not the direction to go, but when you have a situation of stretched fiscal position, it has to be addressed on the fiscal side. The second risk I want to mention is also a financial risk, maybe a bit more bottled up initially, but I think it's nevertheless relevant and certainly relevant for the global economy. It's the unresolved real estate crisis in China. And here, I think that this is something that is still with us. It's been a number of years. Now, we know from historical experience, other countries that have been through a real estate crisis, whether we think about Japan or you think of other countries in the world, it takes time. It takes time in part because this is a difficult problem to solve, but also because there is often a tendency not to address the root cause, not to address it in a way that allows the economy to move forward, because it means realizing losses, recapitalizing financial institutions that need to be recapitalized, and then moving on. And that distributional aspect of who is going to bear the costs of resorbing the crisis is something that often takes time, and from that perspective, China is not in a different position than other countries. This is relevant also in the context of public finances in China. The local government financing vehicles, their debt represent about 47% of GDP as of 2023. The updated numbers are probably not very different, and our estimate is that about 40% needs restructuring. So this is a very sizable problem for China. The resolution has been very piecemeal, very insufficient from that perspective. And so the result is that the Chinese economy is teetering on the verge of a debt deflation type recession, where global activity is and global demand, the domestic demand is weak, price pressures are actually very, very weak. You have inflation being very low, and in some sectors, even deflation. And then therefore the real cost of debt are increasing, et cetera, et cetera. So that's something that certainly is an issue for the Chinese economy. But I would say that it also highlights, if you add to that the fact that the response of the Chinese authorities up until now has been to put all their chips on the manufacturing and the exporting sector to try to grow out of the weak domestic demand through the export sector, we see how in the current environment this is a path that is going to be very, very difficult to achieve. And we see evidence of also overcapacity and deflation in the manufacturing sector and mounting non-performing loans in that sector as well. If you look at, for instance, the solar panel sector, many of the Chinese firms in that sector have achieved tremendous productivity gains, but are also generating substantial losses. Third, I won't dwell too much on it because Klaus mentioned it. We are concerned about what might happen with stablecoins. I want to reiterate what Klaus said, which is there is a business case in many parts of the world for having access to a means of transferring funds cheaply without exorbitant fees. And that offers some amount of protection against domestic macroeconomic policies that might actually be quite detrimental. So I think there is an argument to be made there. But of course, there are underlying risks. One of the risks is, from our perspective, that there could be a rapid adoption, especially cross-border, that if we have an event where you have a run on stablecoins, there are two issues with that. One is if they are holding large amounts of US government debt, for instance, most of the stablecoins at this point are dollar stablecoins, that could impact the government bond market. They tend to be holding at the short end of the maturity curve. They are not holding long term because that would not be the kind of liquid assets that you want to have. So there is concentration on the short end of the maturity curve. If they have to liquidate, that will create a hole pretty quickly. In some jurisdictions, including Europe, stablecoins are also holding bank deposits. Even in the US, if you think about Silicon Valley Bank, one of the reasons one of the stablecoin issuers broke the buck was that because they were a large depositor in Silicon Valley Bank. You could imagine that this would be, that means there is concentration risk potentially on the banking side if you have large amounts of deposits that are concentrated in a few stablecoin issuers. So these are the kind of risks that we have to think about going forward. Fourth risk I want to mention, and that's the final one, is something that we see in the US right now is sizable signs that we have a very strong AI-related investment boom. The size of AI-related investment in the US right now is very significant. Non-AI-related investment is basically flat. Most of investment in the US has an AI component, whether it's software or whether it's data centers and other things. Some of this is predicated on future productivity growth and profitability. What it's doing is that, of course, it's driving up the economy. You can think of this as kind of a demand shock in the near term, maybe similar in some ways to what we had in the dot-com boom period, 96 to 2000, and some of the dynamics may be similar there as well. But then there is a risk of we have what happened in the dot-com. It ended with the dot-com crash. And so one of the risks that we see especially in the US economy is that some of the valuations in the AI sector, some of the very optimistic projections for that sector will not be realized. Now, this matters in different ways than in the dot-com period. One of the things that you have is extreme concentration of this investment in large tech companies, unlike the AI period, the dot-com period, where it was basically pet.com and a bunch of other startups that are receiving a lot of funding. Here you have things that are very, very concentrated, and that matters for how the index might respond to this and might create wealth effects and confidence effects. So one of the risks that I think we should be thinking about is the potential market correction when we're thinking about the AI-related sector. I'll stop here.
Thank you very much, Pierre-Olivier. Actually, many of the risks that you mentioned were focused on other countries, not Europe. So what kind of spillovers do you see from those risks to Europe?
I think not all of them are on other countries. I think I've mentioned fiscal risks first. So I think, I mean, this is interesting, and I mean, I think that, of course, the stable coin is also something that could create some risks for Europe and not just other countries. I'm not concerned about currency substitution, of course, for a region like Europe, but you might have adoption of stable coins that also creates. I mean, there are a number of risks associated with adoption of stable coins. One of them is there are potentially fiscal risks. I mean, to the extent that it might facilitate tax, quote-unquote, optimization. That's something that could be relevant for public finances.
Multi-issuance.
Multi-issuance.
In different jurisdictions.
Multi-issuance is another thing that the ECB in particular and the SRB have been looking at. The fact that, you know, basically, how can you issue a stable coin at par into different jurisdictions when you have different regulatory environments? There is obvious arbitrage there, so that creates some problems. The AI boom has an interesting implication, which is that if you think that it's driving up interest rates, it's sucking up a lot of resources into investments, driving up interest rates. Europe is going to face the higher interest rates because this is a global market. It's not clear it's getting as much of the higher growth. And so the R going to be going up, the G may not be going up that much. That is adding to the fiscal pressures in the region.
Thank you very much. So back to you, Klaas. So you emphasized a lot the risks in the non-bank financial sector. So of course, we've also recently seen some risks materializing in the banking sector. And what we are now seeing is that there is a lot of push also in Europe for what is called simplification, which may end up to be more deregulation. So are you worried about that? So do you also see any spillovers from the risk you identified, like back to the traditional banking sector?
Yes, I do. I think if you think about the banks, it's always good to keep in mind that banks are among the more or even most highly leveraged entities in the financial system. So it means that whenever you worry about systemic risk, you worry about contagions, the banks are never far away. And I spoke about the non-banks, but the separation between banks and non-banks is of course not a black and white separation, because out of the 1.2 trillion, for instance, well, the numbers are not completely comparable, but roughly 500 billion of non-bank, of private credit funding is funded by the banks. So roughly 500 billion, it's not entirely comparable to the 1.2 trillion that I mentioned earlier, but it is safe to say that, let's say, a quarter to a third of the funding of private credit vehicles is provided by the banks. So here you have a possible contagion channel. Yeah, and this push that you talked about for simplification, I mean, let me also here try to start on the positive end. Of course, banking regulation for 15 years has had the wind in its sails, right? I mean, there was growth, there was huge growth of supervision, of regulation and everything. And I tend to believe that if you have whatever business you run, but if you have 15 years of growth in a certain business, it's good every now and then to take a step back and sort of ask yourself, has all that growth really been invested in the right places and the right resources? So I could dwell on that and I have a couple of sort of concrete subjects where I think simplification should be on the agenda and is probably on the agenda. But I would worry if simplification were really to morph into deregulation. Again, what I said, I think I look back on the financial reform agenda that was focused on the banks as a very successful exercise in changing the banks from shock amplifiers into shock absorbers, what we've seen. And that's what we want the banks to be, right? I mean, there is also ample empirical evidence that better capitalized banks provide for more stable lending. We just don't want to see as much lending, but we also want to see stable lending that is not withdrawn at sort of the first instance of turbulence. So if simplification were to morph into deregulation, yeah, that would worry me. I think there is a gap in, let's say, the level of resilience in banks versus NBFI. So there is an unlevel playing field. That's absolutely true. But you can solve it in two ways, right? And at least my efforts in the Financial Stability Board over the last 4 years have been to try to bring the resilience in the non-bank space more up to par with the resilience in the banking sector. Now, in other parts of the world, they now seem to talk about lowering the level of resilience in the bank so that the activity migrates back into the bank. But I would prefer to bring about that migration by actually bringing NBFI resilience up to par with that in the banking sector.
I think we can easily agree on that. So, Pierre-Olivier, you talked a lot about the fiscal pressures that we're seeing in various countries. So, do you see the danger that this could feed into dysfunction in government bond markets, and what would this imply for global financial stability?
Well, obviously, at some level, if I think the fiscal trajectory is not stabilized. And here, I want to emphasize that, you know, it's not that it's increasing and getting out of control in all countries. I mean, when we look at our global debt database, for instance, it's very clear that you have two big outliers. One is the US, and the other is China. For most other countries, debt to GDP, public debt to GDP, has been kind of, you know, went up a lot during COVID, came down with the surprise inflation, and has been sort of drifting up, but slowly, and is projected to continue drifting up. And the question is, how much should we worry about this continued drifting up? And certainly we believe that the many countries should rebuild fiscal space. And one of the reasons why it's important is not so much that if you couldn't sustain deficits or debt levels at the level where they are, you probably could, but probably is not good enough. We are in a world in which we have pretty sizable shocks, if we think about the last 10, 15 years. And one of the things that's been really important, and the empirical record on this is very, very clear, that countries' ability to deploy fiscal resources quickly in a large crisis like COVID, for instance, is critical to mitigate the long-term effect, the scarring effects of the crisis on income per capita. So advanced economies came out much better, and especially those with more fiscal space, much better out of the COVID crisis than emerging market or low-income countries, which are not able to deploy the same kind of fiscal support for their population. You see that very, very, very clearly in the income per capita. There's an enormous amount of scarring that is still there out there in the world. So you need, faced with a shock that is sizable, you need to be able to deploy maybe 10 percentage point of GDP. The question is, and I think this is a point that Raghu was making yesterday, can we afford it if a shock that size happens? And I think that's a valid question. Therefore, the call to rebuild some of that fiscal space. So the question is not so much that necessarily the bond markets won't absorb. I think they will absorb at a certain price. We're seeing right now that it's fairly moderate in terms of the pricing, but accidents can happen, and I worry very much about these accidents.
Yeah, so before we open for the Q&A, maybe can you tell us what do you think are the main solutions to the problems that you identified? So what should the regulators, the supervisors, maybe also central banks, or even governments focus on?
Okay, well, first of all, over the last 4 years that I've been at the helm of the Financial Stability Board, we tried to strengthen NBFI resilience. And roughly, that was subdivided into 2 strands. First of all, you have the entities within the NBFI space, money market funds, open-ended investment funds. And we tried to strengthen liquidity management within these entities, a better management of these liquidity mismatches and anticipation of these liquidity spikes. But then again, the NBFI space is not as homogeneous as the banking sector. Some would argue that not even the banking sector is homogeneous, but NBFI is even more heterogeneous, I would say. And so you also have a couple of cross-cutting issues that are quite important to tackle, and 2 of them in the NBFI space. The first is preparedness for margin calls. The Bank of England has done a sort of system-wide liquidity stress test recently, and the liquidity, the demand spikes in liquidity that they simulated, more than 90% came from margin calls. So liquidity needed to meet margin calls. So that is really an area where I think the financial infrastructure needs to be strengthened quite a bit. The other cross-cutting areas is leverage. Also in NBFI, leverage is there in the 5 episodes that you mentioned. All of them also had in common that pockets of hidden leverage all of a sudden popped up in areas where we had not expected it. That's very difficult to say, if I'm honest. I mean, we issued a couple of recommendations, but most of the recommendations that sort of on which you find global agreement are high level in nature, and we need much more granular follow-up regulations to really address the risks there. The same, by the way, is true for stable coins. Nowadays, you can take a server under your arm and issue these stable coins or crypto assets from any place in the world. So you really can only have an effective global supervisory regime if you also have a commitment to implement. And a commitment to implement, and you also need to have disciplining mechanisms for those that are unwilling to implement, the so-called offshore financial center issue. I don't think all these issues have been solved yet. We need more international cooperation to solve these issues. Well, and that was always a challenge, but definitely today it is a challenge.
Thank you, Klaas. Pierre-Olivier?
I will be brief. I mean, starting with so very clearly on the fiscal issues. I mean, there is a need to consolidate, which doesn't mean, by the way, doesn't mean that somehow there has to be an abrupt stepping on the brakes. I mean, I think what we recommend is that there should be gradual, credible, timely consolidation, and that will signal to the market that you're going to go there, and that will be reflected in funding costs, and that will already provide some help. But we're not seeing that in many jurisdictions. Second is maintaining good monetary frameworks in addition to the fiscal frameworks. And here I want to flag one sort of piece of good news. We are wondering about the next crisis, but one of the places where there's been tremendous improvement in resilience is emerging markets. Emerging markets have been going through the same crisis, but we haven't had an emerging market crisis despite, you know, everything that happened since 2010. So I think that's something to take on board and realize that a lot of these countries have actually done the hard work. They've improved their monetary frameworks. They've made their fiscal policy much less procyclical. They've introduced fiscal rules in some countries. They've introduced macroprudential rules, so they've buttressed their financial sector. So they've made themselves much more resilient and therefore put themselves in a position where they can let exchange rates fluctuate a lot more and absorb external shocks in the way that, you know, we think that they should be doing, and that there's been a lot of progress in that direction. So I think that's a lesson that emerging markets have been doing it. Maybe some advanced economies need to be looking at what's happening there. Third, on China, and here the answer is very, very clear. You need to, you sort of have a transfer of resources. You need to reorient demand towards the domestic sector. The only way to do that is to restore confidence and clean the property sector. Our estimate is about 5 percentage point of GDP to clean up the property sector. So that's a substantial amount of fiscal resources, of course, but there is a substantial amount of resources that are spent, in our view, in a way that contributes to misallocation of activity in China through non-market practices, subsidized lending, subsidies in different sectors. And the reason I'm saying it's contributing to misallocation is if you look at the difference between some of the flagship sectors like EVs, et cetera, we are showing tremendous productivity gains. But you look at the aggregate picture, aggregate TFP in China is really, really, really very low. So that tells you that somehow a lot of things are not going in the right place. On stablecoin, I mean, the fund and the FSB work together. They're very aligned in terms of policy recommendations. This is very high level, and as Klaas mentioned, there is a lot of work that needs to be done more at the ground and the level of the regulators and coordination.
So thank you very much, and we can open the floor for questions. Okay, so maybe we just move from here to there. So please, Amir.
This is a question for Pierre-Olivier, and I can't resist given all of us know Pierre-Olivier is one of the leading scholars on international finance and international macro. Two other leading scholars, Arvind Krishnamurthy and Hanno Lustig, wrote a paper in April, did a panel in May where they suggested that perhaps the US was starting to lose its reserve currency status, given some of the policy decisions. It didn't make your top 4 list, so I was just wondering, is that something you're thinking about? Is that something you're worrying about? How would we detect whether that is happening? Perhaps that we should start ringing the warning bells.
Is it okay if we collect 3 questions? Yes, because we have so many. So I think, Philip, you were the next.
Okay, Philip Hartmann, ECB. So payment and settlement infrastructures have been a bedrock of financial stability since quite a while. And the central banks have learned that lesson quite a while ago, and we developed very safe systems. But now we are entering, and the stablecoin issue is just one example, a period of disruption in the payment side that I personally believe will be with us for the next, say, 5 to 10 years, and can be very disruptive, even beyond payment systems. And what I'm heading for is your advice on the technological orientations of the central banks to keep this achievement that we had since quite a while, that in the recent crisis or in the last 25 years, nothing or really that decisive came from that side. When we go in this transformation, and I'm particularly interested in the side of in kind of assuming ourselves, adopting ourselves some of these technologies that are so successful in the stablecoin, which is the distributed ledger, whether you have advice for us how we should think about this compared to our shared ledgers on which we usually build our main payment and settlement systems. So how we should go forward, like more go in the direction of the market, which has developed some dynamism on the distributed ledger technology even recently, including the stablecoins, or like how we can preserve this great achievement, and which technology we should go, in which technology we should base our decisions. Thanks.
Philip.
Hi, Philip Schnauber from NYU Stern. I also wanted to ask about the stable coins. I mean, I agree with everything you say. You've emphasized this potential for tax evasion, there are worries about runs. But if you take that off the table for a minute, supposed to invest in reserves and actually regulate it, another aspect of this is that there may be a competitor for bank deposits. And, we know that deposit rates don't move one for one with the short rate. I mean, in the US alone, if you think about, we went from the zero lower bound to, max of 5%. At the same time, deposit rates on average went up 2%. That actually, in terms of spread, meant that per year, 20 trillion of bank deposits, banks earned an additional spread of 300 billion per year. That's more than stable coins are actually outstanding. They're on the order of 270 billion. So there's also a big opportunity in terms of, a competitor which, we usually are missing for the banking sector. So, potentially from the household perspective, that may actually be a plus. So there's an opportunity. Now, if a regulator looks at this, we just had a paper on regulators, they may usually say, well, these bank deposits not paying a lot is actually a good thing. It helps financial stability, it contributes to the franchise value. So I think there's sort of another dimension in terms of stable coins, which both has risks, but also great opportunities. And I wonder what your thoughts are on this.
Thank you very much. So who wants to start? Okay.
I'll say something to Amir's question and then maybe to Philip on the competition with the banks. So on the dollar, you're right, it doesn't make my top four. There's always a risk somewhere, but I think it's a very distant risk. We actually looked at the evolution of the international monetary system in one of the reports we put out in July, our external sector report. We had basically doing some stock taking on this. Really, the picture that jumps at you is the dollar dominance is extremely strong across all dimensions. And we know that there are complementarities between these different dimensions, whether you're looking at invoicing, you're looking at debt issuance, looking at reserve management, you're looking at which currency countries want to peg their own or stabilize their own relative to. All of these things kind of reinforce each other, and they're still there. So we don't think that that picture has changed dramatically. We've seen something a little bit surprising in April, which has been, despite the fact that you had volatility in the bond market, you had the yields going up in the US, you had equity markets coming down. Typically, this is kind of a risk-off event. In previous risk-off events, you see the dollar appreciates, there's a flight to safety, and here, well, surprise, surprise, the dollar depreciated. And so there's been a lot of looking at what's been going on with that. Our understanding, and we're doing some work also on this for the annual meetings and our Global Financial Stability Report, is a lot of this is not so much investors moving away from dollar assets. Actually, we still see a lot of inflows, whether you're looking at equities, you're looking even in sovereign bonds, you see very sizable flows. It's more of a change in the demand for hedging. So all of a sudden, what you had is investors keeping their dollar position, foreign investors keeping the dollar positions, but increasing the demand for dollar hedging against a potential decline, depreciation of the dollar, which of course brings it forward. So we've seen relatively stable portfolios so far, and we are not particularly concerned about where we are right now in terms of the dollar status. Now, there are a number of things that could change the pictures going forward. I mean, clearly geoeconomic fragmentation plays a role there. The way other countries, other investors are looking at the dollar really depends on, the set of rules and the set of norms that are implemented around the world. And if these are very substantially upheld or changed, then the picture could change. You could argue that the fiscal trajectory might also matter. And foreign investors might look at what's happening in terms of public debt in the US, and the safety of US treasuries might be something that they want to think about. Although if you look at the recent budget bill in the US, if you add to that the tariff revenues that have been coming in, actually the fiscal picture is not deteriorating at all in the US, or very, very little in the coming years. So it's kind of plateauing. It's not improving, but it's not deteriorating. And then there's the question of cryptos and whether that might actually be a plus in terms of generating demand for US treasuries to the extent that you have dollar-based assets. So it's a little bit of a mixed picture, I think, but there is no sense from where we're standing and where we're looking at the numbers that things are changing dramatically. One of the things I would add to that is one of the really striking features of the world economy right now is the asymmetry you have between trade and finance. I mean, the US is really dominant in terms of international financial flows, but in trade, it's a much more multipolar world already, where you have, China and other countries are very important. And that asymmetry between the role of the dollar in trade, in finance, and the role of the US, the size of the US in terms of international trade, is something that is allowed under sort of a dominant currency. So a sign that we might be closer to something that the system might be changing would be if you have less of this asymmetry, because that means that countries somehow are less willing to specialize along lines of comparative advantage between finance and trade. So that's kind of one place where I would look at. Very quickly on Philip's question on stablecoins, I think that's the big battle that we're going to see. I want to separate the sort of the domestic versus the cross-border aspects. The domestic aspect, there is enormous, in the US, this is the battle. who are going to be the banks of the future? Is it going to be the stable coins, basically? Or is it going to be the banks sort of absorbing the technology and offering this through tokenized deposits or things like that? Now, the stable coins right now are not there because they're not offering direct remuneration, and they're supposed to be holding high-quality liquid assets, so you can think of them as narrow banks. Yes, they are disintermediating the banks, that's possible. They are like a better money market fund because you can make payments with it, you can transfer money, unlike your Fidelity money market account where you have, it's cumbersome to move money in and out. So it's much more convenient than a money market fund, and it's going to come in the banks. And what you can anticipate is there is going to be a push for them to compete even more head-to-head with the banks by starting to offering remuneration and becoming more fractional banking with the risks that come with that. So that's, I think, that's where the regulators have to be sort of holding back and say, no, you guys want to be holding something at par, then you have to be really safe. And you know that. So the banks are seeing the danger, and they are already moving in that space. And I think what shape it's going to take, we don't quite know. But that risk is very much there. So let me stop here.
I think you covered the ground quite well. I mean, on the reserve currency, I can't sort of resist also saying that many people in this room would perhaps prefer to see a gradually growing role for the euro, for instance, as international reserve currency. But I really think that the external strength of your currency is a reflection of your internal strength. And it means that in Europe we first have to sort of do our own homework in terms of strengthening the internal cohesion of the internal market, of our capital markets, of our banking system, etc., before we can sort of start dreaming from a bit of a shift here. And in other parts of the world, there is issue with convertibility of currencies, etc. So the simple reality for the US dollar is also there is no alternative. And I think that will be with us still for quite some time. Philip, you asked quite a difficult technical question on distributed and shared ledgers, etc. And I would not count myself among the experts in that field. But what I do know is that I think that central banks should be active in this space. So if the whole world is digitalizing, I mean, our payment system has always been a mixture between public money and privately created money. Cash is probably, well, I'm not saying on the way out, but it is clearly, its use is severely diminished. I mean, my kids, if you try to tell them what cash is, they sort of look like you're coming from a different planet. So if we want to preserve also a public imprint, let's say, in money, then I think central bank digital currency is the logical answer. It's also a logical answer to keep abreast of these technological developments. And there also a little bit of a geopolitical argument comes into play, that for all the payments instruments that we're now using in Europe, we are very, very much dependent on technology that is coming from outside Europe. Even payments products that seem to be very European or national, if you go at the back office, it's all being driven by 2 or 3 suppliers, let's say, outside the EU, outside the euro area. And well, one wonders with strategic autonomy, etc., whether that is a healthy system to stay in. So I do believe that central banks should be active here. And if we would not be active, I think going forward, we would blame ourselves at some point. How did we allow it to happen that sort of our money system evolved into a complete private money system only? And yeah, I think public money is the bedrock. It provides stability. The fact that money can always be changed into a public instrument, I think, provides stability. And we should cherish that also in the digital world.
Thank you very much. So I'm going to collect 3 questions again from Marcos, José-Luis, Victoria. Could you please be relatively short, and also the answers should be preferably a bit shorter than the previous one so that we can have another round if possible.
So Marcus Brunnermeier, Princeton. I have 2 questions. One is, Klaus, you didn't mention much private equity. I've noticed you spoke only about private credit. Are you worried about private equity, and do you think the illiquidity in private equity is a plus or a minus for causing something? And do you think it will be contained in the United States, or there might also some spillovers occurring towards Europe as well? Then my second question is more generic. Do you see any new mechanisms for crisis? So we heard a lot of traditional ways crisis can emerge and in different traditional areas, but do you see new elements coming, that the speed of a crisis is speeding up much more, that we have AI agents trading or the artificial intelligence introducing new elements in financial markets, which also lead, at least not immediately, but in a few years, to very different forms of crisis as well, or you don't see that?
Yeah, José-Luis Peydró from Rome. So you said yesterday and today that a big risk is the public debt and the fiscal positions. And I got from your comments that this is more once the crisis arrives, you don't have these buffers, and that will be bad for systemic risk and for the economy. I wanted to ask you about the ex-ante build-up of financial imbalances. So if you know that you don't have that money, both through fiscal policy once the crisis arrives because public debt is very high, and monetary policy at the end depends on fiscal policy, could it be that supervision becomes softer? Because then you know that if you want to be very tough with the banks, maybe at the end, close to the crisis, there will be problems in the banking sector, but there is not this backstop. So in a sense, that fiscal policy will not be exposed, will be ex-ante, making the system more prone to financial imbalances. On the other hand, if you know that you cannot save the system, you cannot do bailouts, the central bank cannot help so much, maybe the supervisors become tougher. So what is your opinion on that?
Victoria Washington, Harvard. My first comment, 2 comments. The first one relates to Marcus's a little bit. So private debt today backs primarily private equity activities. The bulk of it is private equity activities. So as of last year, the equity check for a buyout was 48% of the entire capitalization. Let's make it a 50. So it's 50 debt, 50 equity. And so if you're going to go off 1.2 trillion in debt, that means that you have to burn first and foremost 1.2 trillion in equity, which is sitting throughout pension funds and insurance companies, etc. So the question is Marcus's question. What do you think is wrong with private equity first and foremost? And perhaps there is an additional channel that we should be thinking about, which is portfolios of pension and insurance. The second comment relates to concentration. So this idea of private debt being concentrated in particular in a few industries, which is a fact, well-documented fact. That again goes back to the fact that private debt caters to private equity. It shadows private equity. Private equity has always been a very industry-concentrated activity. Industries shift over time, but in any given point in time, it tends to go to specific industries. Now, that actually gives us a window of how to think about concentration of that portfolio, because private equity was funded by securitization, collateralized loan obligations, so broader leveraged loan market in the financial crisis in 2008. So those portfolios, which by the way were levered 9-to-1, were already concentrated portfolios of debt. And they did not default on their AAA securities, which were cutting through 60% of their capital structure. So the question for you is, do you think the industries are different, or what is different, given our experience with concentrated portfolios of debt in 2008?
Well, pretty tough questions. I mean, to begin with the private equity, private debt, of course, every transaction is different, and so to generalize across the entire private equity spectrum, a lot is concentrated in IT and in health. These are, I think, the 2 sectors where you see most of these transactions. In principle, if you have a 50-50 situation, then of course there is a lot more equity in the transaction than is there in let's say, a traditional banking system, which is much higher leverage. And when I think about systemic risk, obviously I am worried about private equity. I'm particularly worried about sort of leveraged transactions, and so in and of itself, therefore, private equity, I mean, it has a negative, let's say, air around it in many of the public discussions. But as long as it is truly equity and people are willing to absorb losses with it, which is the main function of equity, that is not the part that I would very much worry about, and not even the illiquidity. I mean, these are often family offices. They're very abundant, or persons with abundant wealth that put their own wealth on the line. So that is not. I worry more about the private credit part. Because I do think that not all of these exposures are well understood, and particularly the procyclicality element, as I mentioned it, because we have not yet weathered an economic downturn. We've had a massive growth in this private financing business, but the thing is, when we will get an economic downturn, will we not have more sort of domino effects in terms of correlated sellings into falling markets? Will it then be contained to the US or not? Well, I don't know. I think, as I said, also a significant part of private credit supply in Europe is being provided by US entities. So there's a natural contagion channel there as well. So, I mean, it's difficult to really pinpoint how the risks will manifest itself, but at the same time, it has a lot of analogies with fast-growing areas in financial intermediation that we've seen in the past. Then, that was and the new elements. Well, I mean, information is flowing much faster, that's true, but we've worried already for a long time about fast trading, correlated tradings, and AI, I think, is another step up in that development. And yes, it will probably mean that the response will have to be faster. And unfortunately, there is only one party that can react very fastly if there is a crisis response being called for, and that is the central bank.
Very, very briefly, I mean, I think Klaas covered it, but on the new mechanism, yes. So speed, we've seen that with SVB, for instance. The bank runs can happen in a matter of hours, and not in a matter of weeks. Clearly, that makes a difference, and banks need to be prepared, and having access to the discount window may be a good idea. The AI is also important in terms, if you think about how the models are trained. The pattern of covariances that you're seeing in the historical record is what the AI will actually reproduce. It will not have data to necessarily think about a different pattern. And so the question is, if those patterns break down, can it lead to trades that amplify a downturn? And can you pull the circuit breaker fast enough? All right, that's kind of that's how I would put the question. On José-Luis' question on the, I think this is, conceptually, I think you're exactly right, that somehow if you know that there is a backstop, then in a sense you know that somehow the banks are holding that debt are also indirectly protected. That should be factored in. You'd still want to think about the incentives that it provides and whether you want to deal with moral hazard and all of this, but it's certainly part of the environment. Yeah.
So thank you very much. I'm afraid we won't have time for another round, so I think we have to wrap up after a really fascinating discussion, and I would really like to thank my two panelists. I cannot summarize everything that was said, but let me just stress a few points. So I think one point that came out of the discussion is that some of the regulation that may be needed requires international collaboration. And as Klaas pointed out, that is becoming increasingly difficult. And the question is, what does that mean for global financial stability? A second point that I think is very important are the fiscal issues. And Pierre-Olivier rightly stressed the point that this is not just a problem in itself, but that it also has an impact on financial stability, because in the end we are relying on governments to act in case there is a crisis. And that's a very important point. And the third point I would like to stress is related to innovation. So everything we discussed, crypto, stable coins, AI, distributed ledger, and so on. And of course, there's always a question, how much do we want to embrace that innovation and how much do we need to regulate it? And that's, of course, something that also in Europe we have to rethink. So thank you very much. I think we do not have to remove the question mark from the title of the conference. So we are aware of many risks that we face, but we also have many ideas what needs to be done. And so thank you very much to my two panelists and also to a great audience. So I think I can hand over to you.
All right, this is going to be very brief. I don't need 20 minutes. I got to say a bunch of thank yous, obviously, to our host, ECB. I would also like to thank the co-organizers on the committee who picked the program. So if you liked it, it was Luke Levin, Marie Haroa from ECB, and Ross Levine and me from Stanford and Hoover. If you didn't like the program, it's Ross Levine. Thanks to all the speakers, discussants. You all made the discussions lively, engaging. I think it's fair to say in every session there were more questions than could be entertained. There was lots of conversation over coffee. When we were talking about what success might look like, that was what we had discussed, that if there are more questions than answers, it's a good conference, and I think we have done that. That's not to say we didn't answer some things. I think it's fair to say if you look at the sessions, one thing that we kind of got some agreement on is that NBFIs are pretty big. There is a challenge, the perimeter challenge, that where do banks end and where do the markets / NBFIs start? So questions related to, should NBFIs be getting any support and be regulated are on the table, but at least we can agree that they are entities that need to be looked at very carefully. We also kind of agreed that interest rate risk and its interaction with liquidity and run dynamics is pretty important. So when you're thinking about micro and macro prudential regulation, do we have the right frameworks? Have we thought about it in an integrated manner? Is on the table, I think, because right now it seems like some of these policies are probably bolted together, but maybe something needs to be thought of in a bigger way. And then if you looked at the papers today, essentially they were talking about how policy footprint might show up in places which are well outside whatever the target zone is. And the policies, the design and the measurement happens through humans so far. Sorry, Marcus, not just the agents yet. And humans have discretion and judgment. So what's the right design when you're both formulating policies and measuring them, and how much discretion versus rules you need is an open debate. Usually we don't talk about discretion and rules when it comes to supervision and regulation. We mainly talk about it in terms of macro policy, but I think it needs to be brought into the discussion of supervision and regulation as well. And I think we did, thankfully, not answer the question of the conference, the next financial crisis. The question mark still remains. Thank you to the panelists. So I would really like to thank the panelists and the moderator, Isabel Schnabel, Pierre-Olivier Gorinchas, and Klaus Kohn, for bringing on the table a few things which, when we were designing the conference, didn't think about as much, like stable coins. We didn't think about stable coins then. I think we decided on the conference program 10 months ago. So stable coins were still not on the table. So nice to see that that's a risk that we need to be studying. I think we missed the sovereign debt element. That was still there, but probably even more amplified now for all the reasons, including questions that came up about reserve currencies and every country trying to figure out how to sort their fiscal issues, and that getting reflected in the debt markets. And lastly, I think I would like to invite Luke to say a few words, but otherwise I would like to thank again everybody for a pretty engaging discussion that we've had.
This is not part of the official program, very short, but I wanted to thank Isabel Schnabel and President Lagarde, the ECB in general, for allowing us to put on a program with this title. Indeed, it was a fun ride. We picked the program 10 months ago. Our main concern was there would be a crisis in the meantime, so it hasn't happened yet. All good. So it was really fun working with you, Amir, with Ross, with Marie. Where are you, Marie? And last but not least, the most important team member of this effort was Justina, at least at our end. Justina, please join me on stage. So Justina, first of all, has basically single-handedly managed the back office of this conference. She was less stressful than I was, which is quite remarkable. She asked me even yesterday going into the conference, look, I mean, are you okay? All stressed out and all that. And that was a great character trait. I've been very impressed. So thank you very much.
Thank you.
Thank you all. And many of you have come, like Ahmed and Ross, from very, very far. Made your way for this, and we are very, very grateful for that. Also for those of you who joined, there are several academics in the room that normally only show up if they're on the program. We have some exceptions in the room. Special thanks to you, and thanks for everyone else who made this happen, especially the media and communication team. And I wish you good and safe travel back home, and there will be another sequel, maybe a different topic, let's see. All the best for now.